picture a little bit worse. The Magnificent Seven through its index is down about 1.7%, and all seven are lower on the day, Sam. So oftentimes our analysis begins and ends here. We know there's more to the story today, but this part of it is certainly not helping relieve any pressure.
It certainly is not. That is a sea of green, as you can see on our screen right there. Thanks so much, Alex, for helping us out this morning, breaking that all down for us as far as the sectors of the Mag 7 is concerned. Turning our attention to the global market sell-off now. We saw European stocks tumbling on these renewed tariff concerns as the world's financial elite gather for the World Economic Forum in Davos, Switzerland. President Trump's proposed tariffs are expected to hit France, Germany, the UK, Denmark, Norway, Sweden, Finland and the Netherlands. European leaders have slammed this as, quote, wrong and unacceptable. French luxury getting hit hard after Trump separately threatened 200% tariffs on French wine and champagne after France reportedly rejected an invitation to join President Trump's Board of Peace on Gaza. Shares in LVMH, which owns champagne brands like Moet, Dom Perignon and Verve, as well as shares in Remy, Cointreau, are under pressure. Sounds like a bad weekend. Asian equities also getting pummeled overnight. Investors are keeping a close eye on the Japanese market, as we've been talking about, as Prime Minister Sanae Takaichi is expected to dissolve Parliament and call a snap election in a matter of weeks. Concerns about Japan's fiscal spending plans has seen the yield on Japan's 40-year government bond rising above 4% for the first time ever. That's impacting the long-dated bonds around the world. The 10 and the 30-year yields climbing in Germany and the UK today. We're seeing that spill over here in the US. Coming up, it's time for Inside Out. We'll take a closer look at United Airlines and bring you an example trade when Morning Trade Live returns.
Hey, investors, you know the market moves, and Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Back on Morning Trade Live, United Airlines will be in the spotlight this afternoon when the company reports fourth quarter earnings. Analysts are expecting adjusted EPS of $2.98 a pop on revenue of more than $15 billion. Here's a look at the four major American airlines in early Tuesday trade ahead of United's report, and we are all down across the board. United down 1.7, so that is trailing lower. Delta down 2%. That's our underperformer. American Airlines also down over 1% this morning. So let's go inside out on United Airlines ahead of its report card out later. Joining us now is Tom Essay, founder of the Sevens Report. Thanks so much for your time this morning, Tom. So expectations for United?
Good morning, and thank you very much for having me on. Yeah, the stakes are increased a little bit on the United earnings report because last week it's really most alike competitor Delta posted disappointing guidance. So I think that the bar has been lowered a little bit for United into this earnings print. But I expect very strong results. There's nothing to tell us that the premium airlines have seen business slow down. But really the focus is going to be on guidance, and markets are going to want to see United push back against that caution from Delta last week.
Okay, so what is it that they've got to say in that guidance, do you think, to reassure the market and sort of differentiate themselves from Delta, as you say, which really sets the tone as far as the major airlines are concerned?
Yeah, Delta and United are really best of breed in the airline stocks from many people's view. And really from United, look to that guidance, right? The guidance should be $12.50 to $14.50, at least that's what it was last quarter. We're not going to want to see that cut. We'd like to see that reaffirmed. And if they reaffirm that guidance because Delta was cautious, that should be a boost for the stock. More specifically, United, we're going to want to hear strong commentary on the front of the plane, which is the premium portion of the plane where many of these airlines make their most money, and then also international. United and Delta have a very large international footprint. You're going to want to hear good things on that segment as well.
Okay, so we want to hear a little bit less sort of cautious guidance as we heard from Delta. What other sort of metrics are you looking at? Because obviously it was a good year for the airlines, just obviously off the back of how bearish we were at the start of last year, and things sort of looked better than they had perhaps anticipated. What's the story this year with, everything in mind with respect to, where we're at with now the renewed tariff concerns, obviously around where the consumer is at, where interest rates are at. What's the narrative for these airlines, do you think?
So the narrative is a bit cautious, right? I think that as we start this year very similarly as we started last year, because if we step back, there are a lot of things that can go wrong for an airline. I mean, we do have international tensions again. Is that going to impact international travel? It didn't last year, but does it this year, right? Does all this talk of tariff and higher prices further crunch affordability, right? Where now all of a sudden we're seeing these airlines have to cut prices in order to put people in the seats, and that compresses their margin. That's a risk. Then we have the ever-present fuel issues. Are we going to see gasoline and oil prices rebound? And then finally, we're talking about a K-shaped economy. Do people continue to be willing to spend both business and personal on the front of that plane, which is, your first class, your business class, your sort of main cabin plus, that really drives the vast majority of the margins? Or do we see people sort of cycling lower into the middle to the back of that plane, which can be break even or even a bit of a loss leader for these airlines? So as we start, look, there's a lot of things that can go wrong, but they're very similar to what was wrong last year, and the airlines performed well. The consumer stayed robust. I think they get the benefit of the doubt until we're proven wrong, because the consumer has stayed resilient and unemployment remains very low.
Yeah, quite often, and as you pointed out, Delta more sort of aligned with United as far as, what they're doing with respect to being able to fill the front of the plane as well. Quite often with these airlines, they do sort of follow suit as far as, sort of moving in sympathy as far as the performance in the stock off the back of what we hear from these guys. Is there anything from United that we're likely to hear today, do you think, that could move the needle for the sort of broader industry? Or is this going to be a sort of a case this year of really seeing who's emerging as the winners and the losers more so?
I think if United really pushes back against Delta's caution and says, and they've done this, in previous reports where they come out and say, no, we're seeing strong demand from the consumer. There's no signs of any sort of a falling off of the consumer. Then I think that helps the airlines more broadly. I mean, I think for the industry this year, consolidation is obviously going to be an important theme. We still have Spirit out there that's looking to finally be acquired by somebody and see a deal finalized there. So you're going to see some more consolidation in the industry, but it does come down to demand. And if United is positive on demand, I think that could help really offset what we saw from Delta last week.
Not what they do, but what they say. Tom Essay, really appreciate it. Thanks for the setup. Founder at the Stevens Report. We'll speak to you next time. Let's trade it now with Tom White, host of Fast Market. Very good morning to you, Tom. Hope you had a nice long weekend. An example trade for us for United. What's the approach this morning?
Yeah, Sam,
earnings. Volatility is relatively elevated, but the IV percentile ranks only about 25%. This has been one of those choppy trades over the last couple of years, but we did have that nice recent rally to fresh all-time highs. We're about 6% below those levels. Option market pricing in about a plus or minus 6% move in the shares. Either way, in this one, about $6.40. Plus or minus in this one. So I looked at a strategy after that Delta earnings, and your guest kind of talked about this. The Delta earnings kind of took some steam out of maybe what we're expecting from United. They're going to focus on the premium seating, the business travel, maybe as far as fuel pricing also. Is that going to go right to margin? So I looked at a strategy that kind of follows what we saw in Delta, which was a relatively muted move, even though expectations are pretty elevated. So I looked at a neutral short iron condor here. Sometimes refer to this as a short iron butterfly because we are selling the same call and put in the middle of this iron condor here. So in the January 23rd weekly cycle, so just 3 days to expiration, really short-term positioning, earnings type play. We're going to sell the 111 strike call and the 111 strike put. So you're going to sell at the money straddle. And then against it, because we want to stay risk defined, I'm going to buy the out of the money 104 strike put, and then buy the out of the money 118 strike call. So this is basically just outside that one standard deviation, a $7 wide short iron butterfly. You're going to collect a credit of roughly about $5.10 on this. That's what you can potentially make. You can see here from the risk profile, it apexes out right where you sell that short 111 call and put. Now, our break evens, if I collect that 510 credit, are going to be down just below 106 on the downside and just above 116 on the upside. So I've got a nice wide range, about that one standard deviation on this trade to remain potentially profitable. It's positive time decay or theta also. So this will decrease in value as we get closer to expiration, but a neutral strategy here in UAL.
Okay, good look at UAL this morning ahead of its key earnings report out later today. Let's see what it does. Let's see what it says as far as some of the guidance is concerned. Thanks for the example trade for us this morning. We are down almost 2% on this name right now as we do see a more risk-off tone in these markets with the renewed tariff concerns and the threats on Greenland. Thanks so much for joining us here on Morning Trade Live. I'm Sam Vardis. Download the Schwab Network app. Available in the Apple App Store and tune in 24/7 on schwabnetwork.com. We've got Trading 360 coming up with Marley Caden. Have a great rest of your trading day.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it. To leave everything behind, literally come across the entire world, I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Into the trading day. Welcome to Trading 360. I'm Marley Caden coming to you live from our Chicago headquarters. Here's what we have coming up for you in today's show. We'll take a look at how AI is driving retail spending, diving into some of the data that shaped holiday shopping this year. That's in our 360 spotlight. Also, Intel upgraded to HSBC to hold from reduced with a price target of $50 up from $26. George Tillis will walk us through that note and also have an example trade for us in our disruptor. And D.R. Horton reported earnings this morning. We'll break down that report, take a look at where the home builder stands this year in our 360 round. Lots to cover today, but let's take a look at how the markets are faring as we head into the trading day on this Tuesday morning. We are seeing a sea of red this morning. The S&P down more than 1%, 68.62. Same story on the NASDAQ at 25,225. On the Dow, we're exactly 1% lower, 48,865. We've given up close to 500 points this morning. And the Russell 2000 down 0.5% at 2662.98. Taking a look at the 10-year, we are up more than 1% at 428. We are holding outside of that range we've been stuck in. The dollar at 98.30. That is slightly lower on the day. Gold moving higher, another record high here, 47.4210. We're above the 4,700 mark, up more than 3% this morning. Crude oil also trading higher, up 1.25% above $60 a barrel at 62 right now. And Bitcoin sliding again after trying to recapture some of those higher prices and get back into the 100,000 range. We're now at 90,720, down more than 5% today. Do you want to talk about one of the stocks on the move today? Bring in our first guest, Alex Coffey, our senior equities contributor here on the network, to talk about AppLovin. We've seen some seesawing from AppLovin this morning after we got a new report on them from Capital Watch, a cautious report. Walk us through what they're saying there and some of the market action we've seen.
Yeah, I like that you set it up as sort of a seesaw because it's at about 1%, kind of in line with the market's move. It's a higher beta stock. One might say, hey, what's the story here? But that doesn't really tell us the full story. Stock was down like $500 a share in the pre-market, a little illiquid, but it has recovered quite a bit. As you mentioned, Capital Watch, which is an investigation and fund analysis firm, basically issued a report suggesting compliance risk and potential financial crimes within AppLovin Corporation. Now, they allege that the primary shareholder, Hao Tang, and associated networks may have bypassed global anti-money laundering controls to inject funds from China and Southeast Asia into U.S. capital markets. This led to a sort of situation where you saw aggressive selling, and you can see the stocks, actually outperforming the market now. But as the market opened, as the day rolled on, there was buying, obviously, that has happened. I should note, too, this has led to a tremendous surge in the volume, not only of the equities, but the bonds surrounding, this company, as well as options as well. So tons of activity happening. And it's not the first time either that short sellers or, funds that issue, analysis have suggested things that are a little bit maybe not on the up and up when it comes to AppLovin. Of course, you remember back Fuzzy Panda as well as Culper Research both published short reports last year, and the Bear Cave as well issued cautious reports. So question marks, swirling around AppLovin. again, but the market seems to have saw it as an opportunity.
Yeah, it's really interesting covering this company whenever something cautious or potentially negative, sort of an unconfirmed negative, we'll call it that, on AppLovin, because back in October, we got the alerts following some of those fuzzy panda reports that the SEC, can see the spikes here, that the SEC was investigating the business after a whistleblower complaint. We saw very similar price action there too. We saw, a sharp downward move. Then we saw them recover. They ended up, I think, closing the day out a little better than the market did. So very interesting to note how the stock itself responds to potentially negative commentary around its business performance.
Yeah, and in a way, if we kind of took a macro assessment and use sort of an analogy, it's very similar to when geopolitics take over. And it presents a tremendous risk, of course, if it continues to escalate down that path and what's being sort of alleged ultimately becomes true. And that explains why you see these dramatic repricing events. But if it isn't true, it also presents a tremendous amount of potential opportunity. The same goes for the overall market around geopolitics. So what I would say is it increases the volatility of outcomes tremendously because, if this stuff is true and there is issues, you could see dramatic repricing, increases that risk, but with that risk, potential for greater reward as well.
Yeah, certainly. And we can see, the market's sort of weathering this one this morning. Alex, we appreciate you being with us. It's Alex Coffey, co-host of Next Gen Investing. I do want to broaden things out, though, talk more about the macro market and outlook. Bring in our next guest. Joining us, Anthony Soccaro, president of Providence Financial and Insurance Services. Good morning to you, Anthony. We're really now into the kick of earnings season here. We're about to get some big names reporting this week, but we are, starting the week off on a much more negative note, I think, than anyone anticipated. What are your thoughts on the market action we might see this week with some of the big names reporting, but the market action we're seeing in response to some of the commentary we got this weekend?
Yeah, well, there's certainly no shortage of things to talk about. Greenland right now, of course, is what's on everybody's mind. But that goes back to tariffs. And this reminds me a lot of Liberation Day when the market went down several thousand points immediately after Trump's announcement of tariffs kind of broad sweeping. And it somewhat reminds me of that, but of course not to the same scale. But tariffs then fall back to inflation. That's the concern that tariffs bring, is that if it's going to be if there's going to be more tariffs on these exporters or these exporters rather, then what's going to happen is that those prices could get passed down to the consumer. And here in the U.S., we're in a consumer-driven economy. If things are more expensive, then consumers are going to spend less. And of course, that's going to ultimately affect the earnings reports of these companies. If the tariffs get muted or go away, which they haven't, but they've been very tame ultimately compared to what Trump had set in motion in Liberation Day, then everything should be fine. We haven't seen a huge impact on tariffs yet. The PPI recently ticked up a little bit, and that's the manufacturing index. And if the wholesale index ticks up a little bit, that could get passed on to retail. But as the consumer goes, as goes the economy, and as goes the earnings reports, and as goes the stock market. Right now, the consumer's still strong. It's weakening, but still strong.
With all that said, Anthony, what is your outlook for 2026 in terms of what we're seeing from the consumer, what we're seeing from the overall economy? And does any of these announcements that we got this weekend and any of the geopolitical risks that may not have existed when you created your outlook, have they changed it at all?
Well, they really haven't changed it as of now because of the fact that Trump is a good negotiator, and I think this is part of a negotiation process in general. I said that back the day after Liberation Day was announced, where essentially this is all going to blow over, it's going to go away, and the market has reached many, many new highs last year as a result of that. So we're not through the woods. You don't know what's going to happen yet. We're not through the woods yet with this whole scenario, but I think it is just another tactic by Trump, and it seems to be working. But at the end of the day, I don't think it's going to have a huge impact. As far as the outlook on the consumer over 2026, GDP is forecasted to be weakening. We had a strong Q3 for GDP. I think it was 4.3%, and it's going to be closer to 2% is what estimates are saying. For this year, so that makes sense because the consumer is actually spending less as well too. Still strong, but muted because that Labor Department is muted.
And you mentioned PPI already, but what specifically are you watching when it comes to the consumer to keep a close eye on whether that caution and weakening turns into something that might be a more meaningful pullback in overall spending?
Well, I think that biggest thing, without any question in my mind, is the labor numbers, the labor market. When I was doing interviews several years ago, 2 years ago or so, there was 1.9 jobs available for every worker. So a worker could leave and go get another job and probably make more money in the process. If a company wanted to keep a worker like I did, it's hard to go hire new workers. We had to give a lot of raises. And some inflation can be passed on the consumer. You think like grocery stores and so on, they can pass on the price of commodities to the consumer. Commodities up, commodities down, they can adjust their prices. But that's not the case with wage inflation. Wage inflation is sticky. I can't go back to my employees and tell them, look, we hired you and we gave you a raise, but now we got to take that back. That's a part of why inflation is being so sticky, as goes the consumer, as goes the economy. And I think and the consumer is all based on the labor market right now. It's much softer. The consumer's getting softer. Credit card debt's starting to rise a little bit. Savings starting to go down. I think that labor market is the number one thing that I would pay attention to going forward.
So with the labor market softening, we've got a sticky inflation here. We don't have ourselves at the Fed's target. How constrained does this keep the Fed in 26?
Yeah, it actually puts them in a situation that they seem to find themselves in all the time. And that is that, what do we do? Their mandates are twofold: full employment, and keep inflation in check. Employment numbers, I think, unemployment 4.3%, I think. But the bottom line, low 4. And no problem there. With regard to inflation, though, they want to drive it down to 2%. No question that inflation over the last couple of years has come down dramatically, but it's stuck in that 3% range, just depending on which measure you look at. And until it starts to come down a little bit more, they really can't move. I don't see them justifying a move. The problem that they have is that they really want to lower rates. They're looking for a reason to lower rates. Of course, Trump wants them to lower rates as well, but there's no reason for them to lower rates. Yet, if they wait too long, we could have the situation that we had when COVID happened, and that is this transitory inflation that was not so transitory, and they waited too long to raise rates. And if they do the same again, it could come to backbite them, and they could be behind the 8 ball again. That's what they don't want. So they're really in a sticky situation. But I don't see a move this next meeting, and maybe only 1 or 2 moves this year.
So given this environment, Anthony, how should investors think about positioning right now?
So I think it really depends on how you view the market. I think utilities are probably not a bad place to go. They've had a good run. Got a lot of dividends. I think energy's not a bad place to go either with Trump policies and so on. If you want to be a little more defensive, you're worried a little more about inflation being sticky, healthcare is probably not a bad place to be. That's a non-discretionary item. You're going to go get your healthcare regardless of what the cost is. I think that's not a bad place to be either. And if you want to be even a little more careful, maybe consumer staples. Those are the goods that you have to buy regardless of what the economy is doing.
Anthony, we appreciate you taking the time to join us this morning and for the insight there. Anthony Siccaro, President, Providence Financial Services and Insurance Services. Thanks again for being here. And we've got a lot more for you on Trading 360. Next, we've got the big 3. 3 stocks, 3 charts, and 3 trades. Rick Ducat will take us through the technicals. Scott Bauer will join us to take us through the trades for Alphabet, JP Morgan Chase, and GE Aerospace. That's next on Trading 360 on Schwab Network.
trading floor in the world. This is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
Hey, Pop. Hey, Andrew. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim's my financial consultant. I programmed that 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Welcome back to Trading 360. I'm Marley Caden. It's time for the big three. 3 stocks, 3 charts, 3 trades. Rick Ducat, of course, joining us to take us through the charts. Here to take us through the trades today is Scott Bauer, the CEO of Prosper Trading Academy. Proudly wearing your Hoosier gear, I see this morning. Now, we've got red on the boards to kick off the week, but it's unfortunately not because of your big win last night. First, congratulations on the win. Second, love your thoughts on how the week is starting off for us.
Absolutely, and I apologize ahead of time because my voice is shot from last night. So, I don't know what to make of this market right now. It almost looks to me like the market wants to blow this off, meaning that this big dip we're seeing this morning looks to me like we're going to rally back here. That maybe it's kind of that fool me once. It's your fault. Fool me once, it's my fault sort of syndrome here. So I'm not sure that the market really thinks that this is going to escalate. I obviously could be wrong, but I'm not seeing a lot of panic out there. The VIX, which was higher right off the bat, is back down and almost in unchanged territory. So overall, I think this could be a real good buying opportunity.
All right, so some potential buy the dip trades here. This first one, Alphabet, they are trading lower a little. They've improved a little since we opened this morning. Still down about 1%, but just to buy the dip here.
Yeah, and I really like the upside here. We did get in this earlier this morning. The spread that we were looking at was January 30th, so next week. The 330, 340 call spread, just a simple $10 wide spread, paying $2.75. I think this was real good opportunity on this dip to just look for some a basic spread and looking for that upside.
All right, Rick, so as we take a look at Alphabet's chart, knowing that it's had a strong performance over the last month, what is the technical setup here?
Yes, a rising wedge type shape is what's prevailing for this one here. And a chart overall that has held up much better than many other of these big tech names here. Indeed, even making new highs recently before we had this downturn that we're experiencing so far this week. But when we do look at our pattern, we can see that the candle that formed today did open pretty far outside of this trend line that has been developing here. So a bit of a concerning point here, but notice as well that the bulls very quickly rallied back up. Now we are once again on that boundary here. So it'll be interesting to see whether we make our way back up within this pattern, or if this is the point where we'll see another rejection and perhaps the start of a new downtrend or sideways consolidation or what have you here. So when we do look at some sideways horizontal areas to keep in mind here, 340.49 is obviously our high point here. We also had some old highs in this area near 292, which we did not even actually test. We never really retested that old supportive area, the old resistance, which would then you'd be looking for new support to develop at that point. So when we look at our moving averages next, the 5-day EMA in dark blue here, our weekly line, and our teal monthly EMA Prices in between those two near 322 to about 330 or so. So those would be some short-term kind of bookends to be on the lookout for if price makes a significant close above or below either one respectively here. Notice that our RSI has been trending downward here. A little bit of bearish divergence here despite entering the overbought area, which is typically a sign of strength. We did make lower highs on the RSI. Now the trend line has been broken. Finally, if we look at our volume profile study, we can see that the notable areas are here near 320 and here near 290. Those are the heavy trading areas that stand out. Pretty high volume even at these elevated levels. So that would be a noteworthy sign as well if we drop below that point.
And even in those elevated levels, and with the pullback we're seeing today in the broader market and also in Alphabet, we are still trading higher than that right now, just above 326. This next one, your second pick here, JP Morgan Chase, they're down a little bit more than 4% since reporting their earnings last week, but they did post a record revenue in those earnings. It, may have been a timing thing with some of the announcements of the credit card cap and some other concerns, or perhaps just going first. Walk us through this play.
Yeah, I totally agree with that, Marley. Timing could have been poor on that. The market didn't like it. The market didn't like many of the banks, at least the early ones, Goldman Sachs as well. But I really like the way that JP has really hung in there. It was trading much lower this morning. It's rallied back a little bit. In premium, option volatility is still pretty expensive. So I'm selling a put spread for next week, the 310, 305 put spread, looking to collect about $2.25. So it doesn't necessarily mean that I'm looking for a major rally back in JP, but just pretty much hold these levels here.
All right, so Rick, does this setup in terms of the technicals show us that we might hold these levels here?
While we haven't made a significant new lows yet, and also the thing that really catches my eye when I look at this chart is that our longer term trend line is still in play here. You can see this gradually upward sloping trend line. That's about where we hit our low point here. So if we were to make a big break below 305 or so, that would be something that many traders might take notice of as a sign that this more gradual rising pattern is being interrupted then. We did make new highs recently here. You can see 337.25 was a notable high water mark, but in the nearer term, perhaps 318, high point here, subsequent highs here. Well, if you couple that as well, 322, you can see that area there as well gives you kind of a resistance zone to keep an eye on. 318 to 322 roughly would be the potential tipping point that would open the door for a retest of those old highs. When we do look at our moving averages, our faster weekly moving average has crossed below our slower counterparts there. So our blue 5-day EMA comes in around 312 right now. Our quarterly 63-day EMA in yellow around 314. So the faster crossing below the slower is not what you'd want to see if you're bullish necessarily here. But remember, these are lagging indicators. We could be already hitting the consolidative phase here that precedes a rally here, and the moving averages just perhaps have just not quite caught up yet here. So take that with a grain of salt as always here. We can see that RSI still holding true to this downward sloping trend line, still in bearish territory, but remaining out of the oversold area. Our volume profile shows us that the key trading areas from an activity perspective were right about here at the point of control near 310. So that's the most important area of all according to volume profile. Below that though, 300, and above that, 327, 328 or so.
Yeah, right now in that point of control area about 309, but still about $10 below that tipping point area that you highlighted there, Rick. Now, they are down about 1% right now. This last pick, GE Aerospace, trading the lowest out of your three today. They're down about 1.7% as we see the broader market down. And they've got earnings this week, Scott. Is that part of this play?
It absolutely is. And I love the opportunity that the stock is down today so I could potentially get into something a little bit less expensive. So I love the upside here, especially if this stock breaks the 330 area. There's a lot of room to run here. This is an earnings play. So what I'm doing is I'm selling some really expensive volatility that expires this week, buying something else next week. So I'm selling this week's 345 strike call, buying next week's 340 call. So that gives me some upside bias there. It's a diagonal call spread. I'm looking to pay about $1.50 or so for that, maybe a tad higher. That's the risk I have in this. So if earnings flop, stock goes down, that's my risk. But again, I think if we can breach that 330-ish area or so, there's a lot of room on the upside.
All right, so does a breach in the 330 area look likely? And I know, Rick, you always say we can always go higher.
Well, yeah, sure, it's possible. 330 is certainly the area that I would have my eye on as well, because simply that's around where we saw these old highs. 330.279 was the intraday high. But we did not actually close above 330, so a strong close above 330 would really be something that would stand out in the minds of many traders here. More interestingly as well, we can see that the pattern that's developed is more of a symmetrical triangle type shape here, where we have two trend lines converging toward each other, giving this increasingly narrowing range of activity here. One trend line going up, one trend line going down. Not super unexpected that you'd see something like this heading into an earnings event here, as traders become increasingly wary of maybe putting on big positions before the event risk situation here. But it also gives us some pretty convenient areas to watch for a breakout if you look a little further back to the upside. Obviously 330, as we said already. But if you look back here, we had several old highs near 314. That's around where we held on in terms of support more recently too, despite some fluctuations. Another area, 305, a high point from our range, corresponding with 290 roughly, if that period as well could come back into prominence. When we do look at our moving averages as well, in this case, we are seeing the shorter term moving averages above their slower counterparts here, but much like our first chart, we're in between our weekly and monthly EMAs here. Those come in at 321 and 316 about respectively here. RSI showing a similar shape, but not quite as good here, because both of our trend lines are pointing downward here. So the lows are getting a bit lower here. But again, heading into earnings, this is not really all that unusual. I don't think I would make too terribly much of it as well. When we do look at our volume profile, we can see that down here is the biggest node near current price activity, that 300 level. But near where we are right now, 320 stands out as a point of interest before we do hit those highs. That would be the point to hold on to.
All right, we're just underneath that right now at 319.14, even with this 1.8% move to the downside today in GE Aerospace. They will report Thursday morning at 6:30 Eastern. Scott, want to thank you for being with us for the Big Three today. Scott Bauer, CEO of Prosper Trading Academy, and also Rick Ducat, our lead market technician here, for always breaking down the technicals. Coming up, we're going to spotlight how generative AI is transforming online shopping and driving record-breaking retail traffic and sales. That's next. Stay with us.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Welcome back to Trading 360. I'm Marley Caden, live in our Chicago headquarters. It's time to spotlight AI-driven traffic, specifically in the retail industry and over the holiday shopping season. Joining us now to help us do that is Vivek Pandya, the lead analyst at Adobe Digital Insights. Vivek, great to see you. I love when you come with your reports. They're so insightful. You know, one of the biggest things that I noticed when reading through the most recent Adobe data is that you saw AI-driven traffic to retail sites jump nearly 700% during holiday shopping season. I mean, that's just an enormous number. Now, I know you don't have anything to compare it to, but you do have a great deal of expertise. Do you view this as a one-time holiday spike, or are we looking at a more structural shift in how consumers are discovering products?
I absolutely feel that we're in a sort of paradigm shifting moment, really, because of what we've seen over the past 2 years where this traffic has really been surging. And when we had moments like the sales events that we had last year, the Prime event over the summer, President's Day, and then we had the holiday season where it really ballooned up to that 693% that you mentioned. That being up year over year, seeing that sort of trend continue to be that aggressive, I think speaks to consumers really getting comfortable with generative AI platforms, leaning on it for all different types of shopping use cases, and essentially using it as an assistant and a personal shopper through moments like these.
And I know when we spoke, in the preview for holiday season, you said you expected to see a big shift towards this AI-driven traffic and AI-generated shopping experience. We did end up seeing that, but when consumers are using this functionality, are we seeing them actually buy the products that AI is picking out for them, or are they just using it as a reference tool?
Well, it's both. You have many consumers using it for shopping lists and a lot of research-driven use cases. But one of the really exciting things we saw this holiday season was traffic from these AI source platforms was up 31% in terms of conversion or likelihood to purchase on site compared to non-AI source traffic. So when you have conversion rates kind of really pulling away during the holiday season, it's indicative of consumers doing that sort of research on the generative AI platforms, getting onto the site, spending more time on the site, exploring more pages, and feeling more comfortable purchasing. So I think that has a lot of implications for retailers out there.
So Vivek, with what you just mentioned, and also, I made some notes after I read through, we saw like big jumps on Black Friday and that Thanksgiving weekend in terms of the conversion from AI into actual purchases. As we're starting to see these huge triple-digit moves to the upside in terms of usage, do you think that retailers are going to start thinking about AI referrals the same way that they think about or previously thought about being search engine optimized or socially optimized?
Absolutely. Many of the customers we're talking to are definitely prioritizing generative engine optimization and thinking about how they need to show up and how they have to show up differently than they have in the past for these LLMs to pick them up. So really coming through as a brand on multiple fronts because there's a broader conversation happening about their products. What is the conversation like on things like Reddit? How are they showing up on Wikipedia, other information sources on their site? And then also review sites across the board. These LLMs are triangulating a lot of information to give a distilled response back to the user. So it's incredibly important that the brand thinks on all of these fronts to ensure that they get strong visibility.
And as terms of the AI, whenever we have this conversation about using AI in any space to shop or even, in what we do to run through an earnings report or something like that, there's always this side conversation that you have to be careful to trust it. And they even have the little asterisks, we do not guarantee the results are accurate. Are you seeing from a consumer metric standpoint that consumers are actually trusting what the AI is giving them and then they're feeling confident about what it's turning up in their searches?
We are, and I think we see it kind of express itself across three nodes. One being we see a lot of repeat use, consumers, trying this out, getting more familiar, doing it for more advanced use cases. Then we also see in their survey research, many consumers across the board say they trust the results, be it across retail, travel, banking, lots of different industries. And again, back to that conversion rate and that purchase rate on site being 31% higher than non-AI source traffic. That's really indicative of a lot of peace of mind that the generative AI platform is giving the consumer, and they're trusting the outcome. I think when we think about different categories within retail, we saw strength across things like electronics, apparel. We see jewelry. So especially areas where consumers are not too familiar, they're leaning on it for those use cases and those categories. And then we're seeing sort of weaker boosts on things like grocery, baby, toddler products, things like that. So that might be areas and realms where the generative AI platforms could do a bit more work to make them use and drive more boost out of that particular type of category.
And I know we've been specifically talking about retail here, but it is important to note it wasn't just retail that saw an uptick in AI-driven traffic. Where else did we see improved metrics?
We see it across the board, especially travel, banking, financial advice. We see really key utilization across media and entertainment as well. So additional information people are needing. The consumer is in a place where they've gotten to use it across some of these categories they're familiar with over the past year and a half. And now are willing to explore across more industries. I think one of the things we kind of forget is that, even a year and a half ago, we really weren't even seeing many of these platforms have the capability to drive link traffic out of the platforms onto different sites and different third-party sources. So the fact that that's now very possible and consumers are comfortable leveraging those types of use cases speaks to the overall trajectory we're seeing.
And Vivek, as we start to see generative AI become a core discovery channel here, what is the biggest risk for some of these companies that may be a little bit behind in terms of adopting any kind of AI strategy as they try to compete against some of these monster retailers who are already heavily ingrained with their own AI bots and have deals with ChatGPT and OpenAI to direct traffic in and help them check out faster?
Well, I would say that the good news is there's almost like a level setting that's happened in terms of generative AI platforms, and many of these retailers across, however size or sophistication, have an opportunity to kind of, as I said, show up as a brand on multiple fronts, own the social conversation, provide key details about their offering so that the LLM can effectively pick them up. Because the onus is on these generative AI platforms to give these users a great experience and give them exactly what they're looking for, especially if it's a subscribed service model. So essentially, many of these players who maybe missed the boat on other trends like search engine optimization you mentioned earlier, social, they have an opportunity to think about how can they make sure that they show up on all these different realms in order to make sure that they get the strong visibility. Yes, you're going to have partnerships that's going to help certain brands and retailers, and that's why you're likely seeing some of this investment to drive that partnership. But ultimately, it's about the user and how effective they've had an experience. And many of these LLMs are definitely going to be tailored to providing that. So, however specific a user gets around what they're wanting, be it a restaurant or a purchase, or things like different shipping levels, free shipping versus, 2-day shipping, all that sort of criteria, that is going to apply across the broader retail spectrum and across a lot of these services. So that's why they're going to really want to jump on board now versus waiting.
Vivek, thank you for joining us. You know I always love talking to you. I'm always so intrigued whenever Adobe puts out a new report. So I look forward already to our next conversation. But that's Vivek Pandia, the lead analyst at Adobe Digital Insights. Coming up next, we've got the disruptors. We're talking about Intel after it was upgraded at HSBC. George Tillis will bring the news and an example trade next.
connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Trading 360. I'm Marley Caden here in our Chicago headquarters. Let's head out to the New York Stock Exchange for a check on the markets. Welcome in Nicole Petalides, host of Opening Bell and the Watch List. Good morning, Nicole. We're roughly 2 hours into the trading day now. Still looking at a sea of red. I was hoping to look up and see that some things had shifted before we talked. But, what are some of your observations so far in the market action we've seen this morning?
It all started when everybody woke up early this morning and they opened their eyes and they saw U.S. stock index futures selling off in a big way on the heels also of what we were seeing in Europe. And the reason for the sell-off was the Trump administration now alluding to further tariffs, increased tariffs from 10% to 25% on countries such as Denmark and Finland and Germany and UK, and also the talk of Greenland. So all of this really sort of jarred the markets in the early going. The VIX went up from 15 last week up to 20. And when I woke up this morning, the Dow was down about 800 points when I looked at futures. Right now, the Dow's down 519 points. So we're well up off the lows of the day. But the uncertainty about tariffs is weighing on the market. We've also been in a bit of a downtrend. Last week we were down. We're down 2 of 3 weeks. But we certainly see people rushing to certain things that are safe havens, such as gold and silver. Gold is now hitting a new record high once again, went up to $4,756 a troy ounce on a weaker dollar. We're also having some earnings. We saw DR Horton and 3M to the downside after Netflix and United Airlines after the bell. So that's the big picture here. We see the VIX here off the 20 mark, which is the higher points at 1871. And I have to note bond yields, which have now moved up to the highest point since September. The 10-year bond yield, for example, right now at 4.28%, had been around 4.3%, Marley.
Yeah, and you just mentioned what we're going to talk about now, Netflix reporting after the bell today, but we did get an update, and arguably, I know if Sam Vadas were in this conversation, she'd say my favorite story of all, because I am just fascinated by this Hollywood saga. But the Warner Brothers Discovery deal and its potential deal with Netflix had an update.
Oh, this is huge. This is the ongoing heavyweight Hollywood real-life battle, except it's all on spreadsheets, right? And we know that both Netflix and Paramount Sky have been battling it out for Warner Brothers. Netflix has really emerged as the winner. In fact, we got board approval from both Netflix and Warner Brothers. And the story here, and what really solidified this, is that Netflix had a cash and stock deal originally and sticking to that $27.75 a share offer, but now has flipped it to all cash. It makes it simpler. It really brings on more guarantees, and this would now provide Netflix, HBO Max, Warner Brothers Film Studios, and the streaming arm overall. Of course, it's contingent upon the completion of the Discovery Global separation, but it certainly seems like this is the way that the company is going. In the meantime, Paramount Sky has been involved with a hostile bid. They are still hot for Warner Brothers. They have their all-cash offer at $30 a share. They're looking to lawyers, but that's where we stand now, and it's good news for Netflix and Warner Brothers because both boards have approved this. As for the earnings later today, which I know you'll have on Market on Close, we'll watch for Netflix. Earnings growth of near 30% year-over-year growth. Also, profit $2.4 billion, and the advertising, which really could be the #1 revenue generator for Netflix going forward. They're supposed to capitalize, too, on so many future opportunities. So there's been a lot of positive thoughts pertaining to Netflix. So a lot going on here today. Marley?
Yes, certainly. And, even with the broader market trading down, Netflix is higher this morning. They're up about 0.6%. Nicole, we appreciate the earnings preview and also walking us through the latest in the Hollywood soap opera that is the Warner Brothers Discovery acquisition. And now it's time for the disruptors. George Tillis, our senior markets correspondent, is here with today's company. We're talking about Intel. They got an upgrade at HSBC, also significantly bucking the market trend that we're seeing today. They're up more than 5% right now.
Yeah, there's a narrow group of semis that just continue to move higher. Intel is one of them. AMD is actually higher today as well, and I suggest it, possibly has to do with the catalysts associated with artificial intelligence, everything from computing and storage, networking, servers, if you will, as well as cloud and intelligent edge platforms. And Intel is becoming a namesake company once again as a legacy foundry company, as well as a business that has been accelerating its technologies across multiple technologies, Marley. If you look at the other business for Intel, aside from CPUs and even GPUs, their server markets have been growing, networking has been growing, as well as field programmable chips, which are used in factory automation, robotics, and that's where AMD also seems to be shining as well. But Intel just continues to exceed, the pessimists, call for the stock being overvalued. It just continues to move to the upside, and analysts are still quite bullish on this name. HSBC increased their target rating as well as the price to $50 from $26. They had a reduced rating on the stock. Now they've got a hold rating, and they're seeing the CPU markets still as a positive catalyst for Intel, especially the server markets, which are really where high bandwidth memory manufacturers like Western Digital in the storage space, Micron Technology, Seagate, all these narrow-based companies have been moving exceptionally higher in the past couple of months or so, really exceeding the aspects of the mega cap names like Broadcom and of course, NVIDIA. Intel's right in the mix. And again, with the support of the U.S. government, with their investments, NVIDIA, also SoftBank is an investor in Intel. The policy catalysts are there to support the foundry business, which has really been lagging. And I think that's why the stock just continues to hit some new 52-week highs, irrespective of how the market conditions are faring right now.
Yeah, and interestingly, just year to date, they're up about 35%, George, bucking the trend today, seeing some really outsized moves in 26, and like you said, continuing to make new all-time highs. So knowing that they have this upward trajectory, how would you go about structuring an example trade here?
So still bullish. I mean, irrespective of, like I said, the market, there's going to be a narrow group right now that is doing well. And this is one of these companies. AMD is another one. If you look at, like I said, Micron, Seagate, they just continue to inch higher. So we're going to go with a bullish continuation here, but we're going to cap it. And so what I'm going to do in this case is I'm going to buy a long covered stock. In other words, I'm going to sell a covered call against a long stock position. So essentially what I want to do is buy 100 shares of stock and sell the out-of-the-money $52 January 30th weekly calls that expire in 10 days. And you can harvest around $2 a share in credit for those option positions, or $200 a contract. So in essence, what it does is it reduces your cost basis to around $47.50 on the stock by selling those $2 call options, or those $52 call options for $2. In essence, you're still long the stock. Your cost basis is reduced to 47.5, so you still have risk to the downside. But essentially, you're capped to the upside of $52 between now and expiration in the next 10 days. So it's one way to capitalize on a trend continuation, but also reduce your cost basis.
As you always say, George, don't fight the trend. So we're not fighting it here in terms of Intel moving to the upside. Appreciate you walking us through the latest from HSBC on Intel, and also for that example trade. That's George Tillis. Coming up next, we've got our 360 round. We'll be taking a look at D.R. Horton after earnings this morning and what it means for home builders in 2026. Stay with us.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
I'm Alex Coffey.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's markets.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock.
And that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Welcome back to Trading 360. It's time to take a look at D.R. Horton's earnings, what they might signal for the home builders and the housing market. Joining us to help us do that, Aaron Sykes, founder of Sykes Properties, and Alex Barron, president and founder of the Housing Research Center. Thank you both for joining us today. You know, as we talk about D.R. Horton, they have had a bit of seesawing this morning. We did see them higher initially after their earnings. Now, as I'm looking, they're down about 1%. You know, Aaron, let's start with you here. You know, what are some of your key takeaways from the earnings that we got from them this morning?
Yeah, so I think the most important thing we see with D.R. Horton is that they are consistent. Yes, there is some seesawing the stock, and there are some positive moments and then less so in the report as well. However, what they're doing right is they are still offering very commanding incentives. They are working with the new movement in mortgage rates, and they offer a smaller, more entry-level house than their competitors. So they're really positioned well in this affordability crisis to get out in front and make sure that their sales remained relatively stable, even though we're seeing some hiccups in the housing market overall.
And Alex, you know, we saw them beat on both earnings and revenues this morning, though important to note they are declines from the year-over-year numbers. You know, in your viewpoint, is this a sign of strength for D.R. Horton or maybe strength to come? Or as Aaron just mentioned, are incentives doing the heavy lifting here?
Well, you know, all of 2025 was a tough year for the builders, and 2026 we believe is going to be a continuation of that, at least in the first half. And the company guided to lower gross margins for the first quarter of 2026. So what that signals is that in the fourth quarter, they had to increase their incentives and also offer larger price cuts. And they weren't the only builder. We saw pretty much every builder have to do that. And that's because, you know, they're facing lower demand from consumers. There's still a lot of issues regarding affordability, but also confidence. One of the things that is not very well appreciated is that probably the largest consumer segment of new homes today is the Indian buyer. And Indians have been facing H-1B uncertainty related to AI and job security. And so that's been affecting demand in many markets where the Indian buyer is the primary home buyer for new homes. So those are some of the issues that Horton is trying to address through higher incentives and lower prices. But as your other guest said, Horton is leading in terms of offering low-priced houses, and I think that they're going to be doing well this year relative to many of the other builders.
And Aaron, as you both pointed out, D.R. Horton does offer a slightly lower price point home than some of the other home builders. You also mentioned mortgage rates. We're seeing them at some of the lowest levels that we've seen in about 3 years here. But we are still seeing some slow traffic. You know, from your viewpoint, what is holding buyers back still?
Yeah, well, I think it has to do a lot with the general environment right now, the uncertainty in the world, not just locally, not just in the housing market, but truly globally. And I think that people are very interested in still buying a home. I sell boots on the ground in Florida, New York, and New Jersey, resale and new construction. And where we're seeing a lot of activity is fairly priced homes. Sellers finally got a little bit of religion in terms of their pricing power, but we're not seeing a lot of offers come in. So that's where it changes, and the pendulum really swings over to these new home builders where they can offer those incentives to get the buyers over that last hurdle and actually make offers on homes and close deals. So we're almost there. The health of the housing market is better than it was a year ago, but we still have some challenges in the future.
And Alex, you both mentioned incentives are here to stay. They are still elevated, but you did mention that they said that their margins are coming down. From your viewpoint, how sustainable is that playbook here if we don't see a meaningful acceleration in demand?
Well, it's not. That's why I said that I think this year, the first half at least, is going to be a continuation of what we saw last year, meaning that the builders are having to offer progressively higher and higher incentives in order to try to just keep up with the same or similar sales pace. So far this year, in the first couple of weeks that we're tracking sales are down about 15% compared to a year ago. Traffic is down about 25%. So the first order of business is to get traffic in the door, and then you can offer incentives or price cuts or whatever. But that's the thing that's holding the buyers back is, uncertainty, lack of affordability, and just all this global chaos, the headlines that they read, not knowing exactly what's going to happen. But fortunately, President Trump is focused on affordability. He's trying to bring interest rates down. And I think that he will be successful, once he nominates a new Fed chairman. I think it's going to be helpful in driving rates lower, which was the reason that homes became unaffordable in 2022. So I think we're going to see the opposite in 2026.
And Aaron, I'd love to get your outlook for the housing market overall, especially in light of what Alex just pointed out, that the administration is signaling it's trying to fight this affordability crisis. It is focused on the housing market and trying to bolster it. What's your outlook for the year?
Yeah, so general consensus is that home prices are going to improve about 1.5 points over the course of the year, which is a slower rate of, acceleration than is typical. Normally we see 2 to 3% per year. And I think that's pretty fair. I think, if everything that President Trump is doing really hits the nail on the head, then perhaps we can see that 2 to 3% come back. But I think that just having realistic expectations anymore is so important, and that this is going to be a building year. I think things are going to be relatively flat, and if we get anything more than that, it's just gravy.
Well, we appreciate you both being with us to talk about D.R. Horton's earnings and also about the broader housing market. Aaron Sykes, founder of Sykes Properties, and Alex Barron, the president and founder of the Housing Research Center. I also want to thank all of you for joining us on Trading 360 today. That's going to do it for us. I'm Marley Caden. You can download the free Schwab Network app, available in the Apple App Store, and tune in 24/7 on schwabnetwork.com. I'll be back with Market on Close at 3 Eastern, but stay with us. Fast Market is coming up next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey, Pop,
Hey, Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim's my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Welcome to Fast Market here on Schwab Network. I'm Diane King-Hall. Coming up on noon Eastern here at the New York Stock Exchange, and tariff turbulence is once again hitting Wall Street. Let's get right to a check of your scorecard as we hit the lunch hour on Wall Street. The S&P 500 off by more than 1%. Almost every sector of the broadest benchmark of U.S. stocks is under pressure, the weakest being information technology and consumer discretionary, followed by industrials. The one sector where you have some green is energy. But again, we were watching widespread weakness. Blue chips under pressure as well. The Dow down more than 1%. NASDAQ 100, similar to what we're seeing in terms of percent moves, down more than 1%. Russell 2000, small caps under modest pressure. So again, we're off the lows, but down by a little bit more than 1/3 of a percent. Let's get into the roadmap for today's show. We'll look at example option strategies for Netflix. It's sweetened its deal terms for WBD. Plus, the team from Likefolio will be along with new data on United Airlines. It's got earnings due after the bell, and Intel is also on our radar today. It's got some green on the board for that one. Now that we've got the roadmap for today's trading action, it is time to bring in my co-host. You've got Tom White in our Chicago studio, and Ben Watson, Senior Manager of Trading Services, parachuting in today. Kevin Hinks has the day off. All right, guys, we've been watching global markets, especially risk assets, be rocked after this tough talk from President Trump on tariffs. He's been jawboning about Greenland. You've got pressure on equities. Meantime, you've got that movement back in metals. Tom, I know you're also watching the price action on yields, the dollar. Let's start out with you, Tom. What's your take when you look across broad strokes across markets?
Well, I think I think a lot of people, when 10-year yield hit about 4.2% late last week, that was the highest level in a couple months. Now we're up closer to 4.3%. So that added volatility and uncertainty in the bond/yield market is causing a lot of the frustrations here for investors, and it comes on the back of more rhetoric out of the administration that, hey, we're going to slap some more tariffs, starting with 10% on February 1st and then going up to 25% in the summer. And this causes a lot of that consternation. Are we getting into an area where it's going to be a capital type war? I saw some comments from Ray Dalio from Bridgewater earlier this morning that that could be what causes the next consternation or headwind for the equity markets at this point. And once you start seeing this volatility come into the bond market and those yields start to rise, that gets us into a risk-off type of trading environment where leading to the downside is major tech. At this point, all 7 of the Mag 7s are in negative territory here, led by NVIDIA. Broadcom down 4%. So it's causing a lot of consternation. But you know what? We're going to hear some more commentary from President Trump tomorrow out of Davos. That might maybe quell a little bit of the anxiety that we're seeing here today in the equity markets. But hey, Diane, Ben, this is basically just over a 1% pullback for equity markets at this point, just below record highs. The Russell 2000 hit record highs last week. So, yeah, you got to take this with a grain of salt. We're going to hear a lot of commentary out of Davos over the next couple of days, and I think that's maybe what you should be focused on, and then also earnings.
Okay, great point. And Ben, what's your thought when you look broad strokes across markets? Tom making the point that we'll hear more out of Davos from President Trump, the heads of state there, the CEOs there. It's interesting. The president's been on a old school kind of tweet storm on Truth Social today. But again, the tariff talk is really rocking things. Ben, what's your thought?
Yeah. Oh, well, I think Tom's giving Davos too much credit for calming markets. I think that additional rhetoric perhaps may add a little bit in the short term, some fuel to the fire. I think the one thing that perhaps is backdropping a lot of this potential volatility and maybe instability is the echo of what we saw a couple of years ago in the Japanese yen carry trade unwind. And I think with that rise historically in those Japanese bonds, Kevin Green talked a little bit about it this morning. The fact that the response to the Japanese bond auction was very anemic, causing their bond yields to rise. That, I think, suggests that there could be that potential contagion spread here to the U.S. markets. And you see it in the metals market. I think you saw gold moving higher. You saw silver moving higher. Copper, on the other hand, kind of that industrial reflection, was the area that was moving down a little bit more, perhaps, than the other two of the main metal plays. And I think that suggests that some of this concern is location specific. You look at the U.S. markets, the VIX is elevated, as Tom talked about, but the MOVE index, which is roughly the equivalent of that volatility index for the bond market, still remaining relatively sedate. So I think maybe there's some location specific fear going on here, Diane.
Okay, so we really got to pay attention to also what's happening within fixed income, whether we're speaking globally or to Tom's point about the 10-year. Let's talk about some individual names in the one individual name first in the tech sector, then we'll broaden out and talk broadly about the Mag 7. So we got Apple on our radar today. It's getting a bite taken out of that one, but it is getting some love from Evercore ISI. It's added it to its tactical outperform list ahead of its earnings. Citi is lowering its price target on Apple to $315, but it keeps a buy rating. I feel like it's like straddling the fence with that. Tom, what's your thought?
Yeah, I think if you start looking at some of the metrics, and TSM earnings last week was a perfect example. The amount of smartphone sales started to increase. The iPhone 17 did really well, not only here domestically, but overseas. Apple's taking market share in China, one of its key growth areas at this point. So not surprising that we're starting to see some positive commentary ahead of those earnings at the end of this month going into the report, because the stock has pulled back about 13% from those all-time highs that we saw just about a month and a half ago. So pulled back pretty significantly from that 288 level down just about 251. So I think the optimism's there. You know what? They didn't have the big CapEx spend like a lot of the other big players in this space, the hyperscalers, some of the chip names. They're going to leverage their relationship with Alphabet at this point to get their AI ramped up. We'll probably hear some clarity on that. Now, the pullback that we saw on the Citi note took $10 off of their price target down to $315. Some of the costs associated with maybe this AI infrastructure build out are starting to be seen, whether it's memory chips or other types of chips at this point, just due to demand and supply that's out there at this point. That's going to run into some costs maybe for Apple, maybe shrinking margins a little bit. But I think this report that Apple's going to give, and I think this is what the Evercore analyst is, it's going to be a good report. But I think you've really got to watch for guidance moving forward. Are they going to see a slowdown, limiting maybe some upside moving forward? What kind of guidance they're going to give us, and then what kind of clarity we're going to get on that AI Siri build out that everybody's been waiting for, that still hasn't come to fruition, but maybe leveraging that partnership with Alphabet a little bit more. Who pays who for that type of situation? But yeah, it should be a good quarter just based on all the metrics that we have from other companies and Apple itself giving updates.
Listen, I contributed to this possible super cycle here with the iPhone 17. Counterpoint Research says that Apple is the largest, it took the largest smartphone market share in China. So that's a win for it as well in the fourth quarter. Ben, what's your take when you look across Apple?
Well, I'll tell you what, I'm going to do my best Kevin Hinks imitation here and say, remember, Diane, if AI is being used, it's likely going to be used on an Apple device, whether or not Siri and their AI build out is happening or not. And I was part of that super cycle as well in that move. But I think there is that potential, to Tom's point, that come this earnings announcement and the guidance statement forward, that could be some potentially good news. You see, if looking at the chart, that it's breaking a couple of key support levels. You've seen a couple of bear flags in a row here from a technical perspective, but the 200 period moving average still moving higher. It still has some bullishness. I think you look back into the October timeframe to the previous kind of major lower low here, and I think it's got a little ways to go. That trend is still intact longer term, just from a technical analysis perspective, regardless of what the expectations are for the earnings announcement, Diane.
Okay, let's broaden out and talk the broad-based weakness that we're seeing in the Mag 7. NVIDIA now down more than 4%. Tom, you called this out. And look, I know investors in this one are like, come on, we're back at 170, back below 180 now. What happened? You've got Alphabet, Google down. You've got Microsoft under pressure. You've got Meta under pressure. You name it in the Mag 7. It's back again with the kind of Mag 7. Tom, what's your thought?
Yeah, geopolitical tensions, right? Rising interest rates putting tech here. Now remember, tech led most of the rally and, for most of 2025 until we kind of flattened out. The Mag 7's basically flat since September on a percentage basis. So it hasn't done much, but it was a leader. Now, when stocks get hit and it's risk-off trading, tech's probably going to take it on the chin more. I think some of these concerns from the commentary out of President Trump and the administration about more increased tariffs, that's lending some of those headwinds to markets. We talked about NVIDIA last week, where the fact that, hey, it did hit above $190 just late last week, and now it's back below $180. And it's a head scratcher to me because we've gotten some good results out of TSM. Demand's still there. The AI infrastructure build out is still happening. CapEx spend is still ramped up at this point, and they have the chips that are in most demand, right? They own 90% of the high-end chip market at this point. So we've got to wait a few weeks until earnings for NVIDIA on this one, but it's been a head scratcher for me. Now, you look at the rest of the tech names, it's not surprising. Some of these higher beta names, maybe, canary in the coal mine type of stocks where, hey, they're going to lead to the upside, but they're also going to probably lead to the downside, and that's what we're seeing today. Maybe that interest rate risk a little bit, trade risk, and geopolitical tensions lending to those headwinds that we're seeing in this space. And until this turns, guys, I just don't think we're going to see a sustained rally until we see tech get back on board and start leading to the upside again, if it does.
Well, Jensen Huang, I know, is also expected to be in Davos as well, so he'll probably try to kind of smooth things out. But yeah, I agree with you, Tom. It's been a head scratcher for me as well. Ben, what's your thought when you look across not just NVIDIA but the whole Mag 7 group?
Well, I'll tell you what, I think I look back at the narrative that we've been talking about here on the Schwab Network and elsewhere, and really it's been over the course of just the last few months that we've seen the major narrative shift to the halo around this AI build-out. I mean, you think about the focus that we've placed on some of the power stocks and some of the infrastructure names, and I think it seems logical that as some of the tech high flyers, those Mag 7 stocks, start to get to some of those higher prices. You see it with the roll-off in Netflix or in NVIDIA right around that October-November timeframe as the price starts to roll a little bit lower. That's about the same time that some of those power plays really start to gain some traction. So, retail investors, just like institutional investors, are looking at that halo as well and looking for places that they can roll out of some of these names that have been outperforming, if you will. and into some areas that may have some upside potential in the short term. Doesn't mean they won't come back necessarily to the Mag 7 when these are at perhaps lower prices, bouncing up off of a support level, which you see a major support level in NVIDIA down around that 170, 172 range or so. Long-term trend still intact, some momentum still moving there on this particular stock, Diane.
Okay, so earnings season, that carries on today. You got investors digging into results from 3M and DR Horton today. The tail of the tape with 3M, though, that one's being rocked. It's down about 8%. DR Horton close to neutral. They're saying incentives will last throughout this year. Tom, what's your take when you look across, there's some earnings that you on. I know we've been focused a lot about headlines, and there's been headline risk, but what's your thoughts?
You look at DR Horton, it was a pretty good report if you just looked at the top and bottom lines. They beat, but one of the keys, and I think this is the focus that investors have, the stock's down just about 0.5% at this point, is that margins continue to weaken. The incentives that they have to do for these home sales are causing those margins to shrink a little bit. And the competitive nature within this space. There's not enough supply out there, right? Home prices are elevated. The 30-year fixed mortgage rate still above the 6% level. I've been kind of pounding the table until we get in the fives. We're not going to see any sustained growth because of the incentives that these home builders have to actually apply to their sales at this point. And that's going to hurt margins, and that's going to hurt growth. So until they start having to do incentives, until we see a 5 number, maybe mid 5.5, but down to 5%, on 30-year fixed mortgage, I think this sector in general is going to remain under pressure. I mean, you looked at it even in the middle of 2025. I mean, this was in basically a recession type of sector. The home builders at this point, they're still giving decent sales at this point because of the demand that's out there. But when you start seeing shrinking margins, incentivized buying from purchasers, and then competition coming into the space, that's a trifecta for some negativity here. I think we're seeing just a small pullback. The stock was initially higher, but until they can turn those margins, start increasing those, shows some better growth as far as not having to give incentives, maybe we're going to have some headwinds in this sector.
Okay, good points there. And then 3M, that stock right now turning in its worst day since the tariff turbulence we had in April of last year. Ben, what's your thought?
Well, you got to remember that this isn't just Post-it notes. I mean, 3M is, you go back to their original name, Minnesota Mining and Manufacturing, and they do still have a fair exposure into some of those rare earth spaces, as well as the mining and industrial space from a technology standpoint primarily now. But I think when you start to see that geopolitical instability that specifically focuses on materials and the metals space, that is going to come home to roost, not to mention the fact that industrial challenges and those tariff impacts in terms of manufacturing are going to come back on a company like 3M that has a diversified space out there, Diane.
Well, I learned something today. I didn't even know the original name of 3M. Thank you, Ben. All right, we got bull versus bear coming up. Good stuff, guys. The guys will get their example trades put together for Netflix. Our audiences want to show up for this stock. We'll have more Fast Market after this break.
DHH, ADTX, SEGG,
DPRO, NUAI, MRAL, UAMY.
THH,
NUAI.
NUAI.
Whether you're an experienced investor or just getting started,
SEGG.
Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach.
NUAI.
It's interactive
NUAI.
learning at its finest. Tune in
POLA.
live or watch on demand. Head over to schwab.com/coaching and start learning
SEGG.
today.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest
POLA.
with Schwab.
Welcome back to Fast Market here on Schwab Network. Netflix is set to report its
NVAX.
results after the close of trading
SEGG.
today. Wall Street's expecting the streaming giant to report earnings of 55 cents a share on revenue north of 11.9 billion. It comes at a time when Netflix
SHPH.
has sweetened the terms of its offer to buy Warner Brothers Discovery. The company is now making an all-cash offer for WBD's studio and streaming assets for $82.7 billion. It's an effort to solidify its
POLA.
pole position as Paramount jockeys around the Tinseltown heavyweight. All right, time now for the tug of war on Netflix. For that, let's welcome
SEGG.
back in our co-host Tom White and Ben Watson. It is bull versus bear time. So before we get to your example trades, we got to get your thoughts on Netflix. Ben, I'll start with you and your thoughts on Netflix.
NVAX.
Well, I'll tell you what, Netflix is primarily a content player, and in terms of streaming, content is king. You know, they're just coming off of the Stranger Things finale, so my question is, does the stock price enter the upside down and start moving in an inverse
SEGG.
relationship to
POLA.
what we've been seeing? The other thing to think about here, Diane, is the fact that coming up, starting this week, you have one of the major issues for Netflix, and that is the acquisition of new content with the Sundance Film Festival. By the way, the last time that it's here in Utah, and that is their primary hunting ground. They're going to be going up against the likes of Paramount Skydance for content, not just for Warner
SEGG.
Brothers. And so this battle is going to rage across a couple of different fronts, regardless of what's going on with the geopolitical landscape. It comes down to who's
IBM.
creating the content and what are they going to pay for it at the film festivals. And this is the first one out of the gate here, Diane.
Yeah, the Game of Thrones is definitely not over with this one. Tom, what's your thought on Netflix before we get into the example trades?
Well, I wonder, you know, had they not put in this bid for, Warner Brothers Discovery, where would the
SEGG.
stock be, right? We're nearly 34% below those record highs that we saw in the summer. We're in bear market territory for this
IBM.
stock. It seems like investors are betting with their, their shares. They're selling their shares because are they overpaying for this asset? And it's not even all of Warner Brothers Discovery. They just want the streaming parts of the business. It's going to add 95 to 100 million subscribers just from HBO Max. But at the same time, are they paying too much? And I think that's a concern for investors. Last earnings, they beat. It was
IBM.
kind of a mixed quarter because operating margins came in a little bit. The growth probably wasn't where the street anticipated going into that report. We're down pretty significantly from those levels. I think those are the questions that they're going to have for investors is how are they making this accretive immediately, how they're doing on the ad-supported tier, which seems to be a majority of their new subscribers at this point. They don't give subscriber numbers at this point anymore, so you don't have any clarity. And remember, in the last quarter, they didn't give any fiscal year 2026 guidance moving forward. And that also put some pressure on the shares in the near term. But yeah, this thing's just been, if you look on a
SEGG.
technical basis, I know Ben does that. The death cross is in play. It's below its 50. It's below its 200.
MDIA.
And it continues to move to the downside. So yeah, this is a big key earnings event for Netflix.
Okay, so that begs the question: is this going to be bear versus bear? I don't know. Ben, you haven't What's your example trade approach, Ben?
Well, the trade that I came up with here on this perspective is slightly bearish, but keeping in mind that potential for a support floor, maybe in this case down around that 87 mark. So not even honestly bearish, because Netflix again is the juggernaut when it comes to content, and you've got a momentum increase here starting to pick up a little bit on the RSI. So what I looked at here was trading this volatility that is still elevated into this earnings announcement, and I went with a calendar spread, but on the put side, so you get that additional kicker, so that if the price does surprise to the downside, looking for a little bit of an increase in that implied volatility here, but seeing it roll off perhaps a little bit in the front month. So I went with the January 30, February 20th put calendar spread at the 87 strike, expecting the price of the stock to settle a little bit into that 87 support level. Relatively low cost to entry in this trade, and a pretty wide with an additional possibility of rolling that short strike, that short 87 put, maybe once, maybe even twice here in that interim between the front month and the back month here on this calendar spread, Diane.
Go ahead and take it here, Benny. Yeah, let's break this one down. You went out to the February 20th monthly options here, so you've got about a month to expiration, 31 days, buying that 87 put and then selling that same 87 put in the near term January 30th weekly options that expire in about 10 days here, paying roughly about an 80-cent debit. There's your risk, $80 per spread with the apex of profitability at or near that 87 strike. But as Ben mentioned, this is almost like an at-the-money, just slightly bearish type of position here. Gives you that exposure without that much risk on it, lower risk on it with only $80 in risk per spread. Now, you look at this and you go...
Well, the holidays have come and gone once again, but if you've forgotten to get that special someone in your life a gift, well, Mint Mobile is extending their holiday offer of half off unlimited wireless. So here's the idea. You get it now, you call it an early present for next year, like 11 months early, which takes you from the worst ever to the best ever.
That gives you credits.
You already f***ed up, right? What do you have to lose? Look, I realize this pitch may not work.
Positive time decay type of trade. You're buying a little bit of Vega because you're buying that February 20th monthly options also. So there's the, I would say, Ben's trade's more of a neutral to slightly bearish type of position, but just a low cost entry point to get some exposure to the stock staying here, going a little bit lower, but you got a decent range on this one. I flipped the script here. I went a little bit more aggressive, and I'll break down the reasons why, but here's my trade. This is out in the February 20th monthly options also, 31 days to expiration, Ben, on this one, because it's about pricing. So it's not a pure earnings play, but you're taking advantage of a directional bias on this one. I'm going to buy the 88 strike call in February and then sell the 95 strike call. So a bullish $7 wide call vertical. You're going to pay roughly about a $275 debit on that. That's your risk, $275 per spread, with the potential to make $425 if it goes above the 95 strike into expiration over the next 31 days. Break even on this one, $90.75 to the upside. So on a percentage basis, you're well within that one standard deviation range. But Ben, the way that I looked at this, if you were to do that same spread in the near-term options and make it a completely earnings type play where you bought the 88 strike call and sold the 95 strike call in the January 23rd weekly options, that'll still cost you $250. So for giving yourself an extra basically 28 days in this position, you're only paying $25 more in risk for that same exposure to the upside. Ben, your thoughts on the bullish call vertical?
Yeah, you know, Tom, going into the earnings announcement, there is that potential for some substantial movement on the price of the stock. And I think, you know, because this is a directional trade, it relies on that directionality of that stock price. That possibility of a quick move could be beneficial in this case. If it were to just simply kind of coast higher or maybe kind of take its time or wander about in the upside down here, if you will,
that could be
SEGG.
detrimental to that additional duration, but at the same time, you got theta working in your favor here because it's working against that short strike that you have in this trade. It's working against the long strike, but that long strike is more likely in the at-the-money position, where that's probably offset perhaps by maybe some mitigation in that volatility. I like the aggressiveness of this trade here, Tom, and the fact that it's got a relatively low cost to give you that
SEGG.
additional duration, which gives some time to adjust. The challenge, though, in that particular case, though, I think, is you also have a little bit more time value that you're paying for this trade. Not that much more, but it still is a pretty aggressive directional trade. It does make a quick move and puts it into that position of being both of these legs being in the money. Even that potential for an early assignment in this case puts it theoretically close to maximum gain in the trade.
Yeah, that flexibility you
SEGG.
get with a directional trade like this where, hey, I've got 31 days in it, but if I get the move on this above 95 and this thing expands to up to $5, $6, something along those lines, it gives you that flexibility to, hey, if the market's open, I can close this ahead of expiration. I don't have to wait that full 31 days. So, Diane, there you go. Two trades. One bends a little bit more neutral. Mine's a little bit more aggressively to the upside. But I think the key is neither of these are pure earnings plays.
SEGG.
You've got some duration.
Yeah, but indeed, will we be tuning in? We will be. Will others be tuning in and binge watching the results from Netflix after the bell today? I know you all will be. All right, Ben, thank you for stepping in today. That's Ben Watson, Senior Manager of Trading Services, Charles Schwab. Thanks, guys, for the example trades as well. We've got cash tags coming up. The team from Lightfolio will be along with new sentiment data on United Airlines. It has earnings due after the bell today as well. Stay right here on Schwab Network. Fast Market will be back after this break.
Hi, I'm Alex.
I'm Jean. And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
I'm Sam Bartis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
Welcome back to Fast Market here on Schwab Network. I'm Diane King Hall alongside Tom White in our Chicago studio. Time now for our cash tag segment. For that, we want to bring in our next guest, and that's Landon Swan, co-founder of Lightfolio. We are taking a look at United Airlines today. That stock under pressure ahead of its quarterly results, which come after the close today. We've got new sentiment data on this. Why don't you take us through broad strokes, your sentiment data, Landon?
Yeah, sure. So this is, just looking at the stock to start with, this is a $52 stock in April, and it's 110 now. It was as high as 119 not too long ago. And you don't often get to see the sort of the K-shaped economy play out in company as you do in some of these airlines. Not all airlines, but some of them, and United is one. So, they've got the premium class of service, and they've got the economy class of service, and it is, it's the K-shaped plan out exactly right. So, across the board, the economy travel sector is not doing great, but the premium is doing really well. And you can kind of see here, just based on what people are searching for specifically with United, they're not looking for the economy seating. They're not, those kind of travelers are traveling less, whereas people that want nicer seating, more comfortable, more amenities, those numbers are up significantly. We saw it with Delta last week, and we're seeing it with United, we believe, coming into this earnings report. So we think this is going to be an interesting move, again, supported by those premium travelers, and everything that we see is positive on United. We just worry about potentially the bar being kind of high. I think that Delta last week, I think it was exactly a week ago, they beat, but slightly, and then the stock sold off a little bit. United sold off with them on that day, about down to 115, I think. So we're actually lower now than we were after United Airlines investors got to see what happened with Delta. So there may be a little bit of a mixed expectation going into this. I think expectations are fairly high. Probably a lot of people know what's coming. But yeah, just to be clear, we're expecting good numbers, again, supported by the more expensive seating, the more expensive pricing things, and less so by the economy, where that's actually struggling quite a bit.
Landon, I noticed with the one chart that you have where the price of the stock, you mentioned it, it's still about 6-7% off of its record highs that we just hit recently. So is that barometer that Delta gave us because they compete head-to-head, even though maybe Delta's got the better balance sheet at this point, where you just expect the same? Where
CRBS.
It's about premium seating, it's going to be about international travel. I did notice that last quarter that capacity increased 7.2%. Typically, you see stocks get hit when they increase capacity, but is that maybe the outlier here where, hey, maybe that comes back in line with the price of the stock, maybe it falls a little bit, or is it already built in just due to the move post-Delta?
Yeah, I think a lot of it's probably built in, but I will say that when we look, you look at this demand chart, the stock price is in that white line, the blue line is in the consumer demand, purchase intent. It's obviously not high, but it's very seasonal. Compare now to January of last year, and you can see it's much higher, trending higher. So we're expecting the summer to do bigger numbers than this last summer. So definitely trending in the right direction. But I also think there's a bit of an X factor in happiness. Consumer happiness with United is actually moving up about 7 points on a quarter-over-quarter basis, which is a big move for an airline. And we attribute that to the brand loyalty. We know that their card spend is up significantly. Their cancellation rate is the lowest in their history this last quarter. They've also got Starlink installed on about half of their fleet, with the rest of the fleet getting that upgrade over the next year or so. So people are talking about being more satisfied. Their flights are canceled less. It's a better experience. They're getting great internet. All of those things. There's a lot of brand loyalty going on with United. So that could be a bit of an X factor. Delta has always had very high customer happiness. I think that United's lagged historically behind Delta, but they're starting to catch up. So that could be a bit of a move that, obviously they're not going to report consumer happiness numbers that we have in their earnings report, but it is going to be reflected in the amount of people that are traveling and the happiness there. So we can actually see the demand. We've kind of got two winners and two losers when it comes to airlines. It's Delta and United doing very well, and then American and Southwest not doing well. Southwest the worst, and I think it plays right into that whole K-shaped thing. I mean, Southwest does not have any kind of premium seating. It's not no first class. Everyone's basically the same, and so they're suffering while all these other airlines that are doing better have those better seats and higher priced amenities are doing better because they're able to sell to the top half of that K-shape. So again, I think that the consumer happiness is probably the X factor, which obviously isn't going to be reported, but it could play out in how much people are flying, how much they're spending on their credit card, what they're booking in the future, those kind of things. So, we do know that they're basically expected to have the highest revenue quarter ever this quarter. Expectations are high. Last quarter, all 7 of their hubs were profitable. They're doing things right, and everyone knows that.
CRBS.
But again, what people may not know is their customers are happier than they've been in a long time. It's the significant move to the upside. A lot
ACRS.
of that has to do with things that have been around, like the brand loyalty and the credit cards, but also some newer things with the cancellation procedures that they've implemented. Cancellations are way down, and again, of course, Starlink, which everyone loves to have fast internet on a flight.
So, Landon, I'll say that I've noticed the difference too, as you mentioned it. United tends to be my preferred airline just because of the location of the hub for me. So I've noticed what you're talking about. I'm curious to know your thoughts on this. Are investors too pessimistic, though, especially given the data that you have, and then how they've leaned into premium like Delta?
Yeah, I think that, so that's the thing. I think that you look at what the stock was, it was 119 not too long ago. Now it's at 110.
IBF.
It sold down to, I think, 115 after Delta. So it's even lower, 4 or 5% lower than after Delta reported. So after that known is coming into the market, it's only what's unknown. And I think that, yes, a lot of people are expecting good numbers out of them, but I still think that there's upside here because of the fact that the stock has pulled off of these all-time highs. The markets are down a little bit. Everything's getting hurt a little bit, but I think the numbers are going to be strong enough to support an investor thesis of 110 seems a little low, right? I think that that's what the investors are going to come back with after hearing this report. I don't think that we're going to, get to 120 and break new all-time highs on this report, but I do think that we're going to move up. I think we're more likely to move up than move down. That's for sure. Just based off the strength of the data, there's not a lot of negativity. The only negativity that I have is that the stock is doing well, but again, it's off since Delta reported good numbers and sold off a little bit. So I think the pessimistic investors have likely been shaken out. They're sitting on the side of cash, and maybe when they see some of these numbers come out, they'll want to jump back in.
All right, thank you, Landon. That's Landon Swan, co-founder of Likefolio, with a deep dive into the latest sentiment data they have on United. So we got their thoughts, their insights, or excuse me, their data, Tom. You've got the trading perspective for example trades, but your final thoughts on your example trade?
Yeah, Landon basically mentioned it. It's like a duopoly, but you've seen improving data points from Likefolio. It was always Delta was above everybody else, and United, American, Southwest always lagged as far as the big four airlines goes. But this is a change, I think. But you have to start wondering, is it already built into the stock? Because the fact that where we came from those April lows, remember, this stock was out in the low 50s in those April lows, and now trading just over 110 bucks. So that's a concern. Still down about 7% from those record highs that we hit earlier this month, pre-Delta earnings. So I looked at a strategy that maybe takes advantage of some consolidation, takes advantage of the higher implied volatility in those near-term options, but then also you want to stay risk-defying going into this report. A neutral strategy that I'm looking at here, Diane, in the January 23rd weekly options, so just 3 days to expiration, where I'm going to sell a short iron condor as a neutral strategy. We sometimes refer to this as a short iron butterfly because you're selling the same strike on the call and put on this trade. But let's break this one down. You're selling the 111 at the at-the-money 111 call and selling the 111 put. So there's your short straddle.
CRVS.
And then to make it risk-defying, we're going to buy a strangle. We're going to buy the January 23rd 104 strike put on the downside, and then buy the 118 strike call on the upside. You're going to collect roughly about a 520 credit for this one, but you can see here from the risk profile, got a nice wide range between about 105.80 on the downside and 116.20 on the upside to remain potentially profitable on this trade. It's by selling that straddle on the 111 strike, you want this to consolidate, but you have that nice range. If you collect the 520 credit, you've got $180 in risk, but that's all the way above either 118 on the upside, or if the stock goes below 104 on the downside. I think that's key. You're risking only 180 to make a potential 520 if it settles around that 111 strike. Now, that's one of the things you have to consider in this one. Because you're short the call and the put on the 111 strike, you're going to have some assignment risk on either one of those, whether they're in the money. So you take that in consideration where, hey, if the stock consolidates here, implied volatility levels fall, and then time decay is working in your favor. The idea here is you sell it for 520 or so, and then you buy it back cheaper if the stock consolidates between those break evens. That's the whole idea on this type of position. You got 3 days until expiration. The option market pricing in about a plus or minus $5.50 either way. That's only about 5% move either way. So we've seen implied volatility levels come in a little bit earlier this morning. That was about $6.50 either way. So we've seen implied volatility levels come down on this one, but this is a neutral strategy aiming for the stock to kind of consolidate, gives you that opportunity to potentially buy it back cheaper over the next 3 days in this type of trade. I think the key is, Diane, it's still risk defined, so you know exactly what your downside is. You just don't want one of those two or three standard deviation moves either to the upside or the downside. You want some consolidation over the next couple of days.
Okay, all right. Thank you, Tom. We've got the breakdown coming up. We're taking a look at Intel. That stock's trading against the grain today. It's higher, one of the top movers in the S&P 500 to the plus side. We'll be right back.
CRVS. ACRS.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services. Schwab Network. Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab
Yeah,
offers
man.
a webcast that's right
So,
for you.
you on the
Platforms
break?
and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate schwab.com, thinkorswim, and mobile-based platforms. Best of all, you can ask questions.
I ain't no Tyrese Maxey, what's going around you?
It's interactive learning at its finest.
Who?
Tune in live or watch
The young nigga? The young
Head
nigga?
over to schwab.com/coaching and start learning today.
Dallas nigga. Straight out of Dallas.
Welcome back to Fast Market here on the Schwab Network. I'm Diane King Hall live on the floor of the big board. Before we get to the breakdown, let me give you a check on where markets stand as we get
CRVS.
closer to the bottom of the hour. We are still looking at
That's
pressure.
who we are.
The S&P 500 now lower by more than 1.5%. Dow off by 1 and about a little bit more than 1/3% there. NASDAQ 100 lower by 1.5%. Similar price action to what we're seeing in the S&P 500. Russell 2000 also accelerating losses now as we get towards the bottom of this hour, off by 0.75%. On the flip side, Intel's adding to its
SEGG.
massive run this year. It is trading more than 4% higher right now, approaching a 5% gain. That brings its
CRVS.
gain to more than 30% in just 3 weeks' time. It comes after more analysts jump on board with Intel. Among those is Seaport. It's upgrading it to a buy rating. It's setting a $65 price target. Wedbush says, be ready for stronger than expected quarterly
PCCA.
results when it reports. Time now for the breakdown. For that, we want to welcome in George Solis, Senior Markets Correspondent for the Fundamental Look at Intel.
SEGG.
I mean, in a sea of red on Wall Street today, you got Intel standing out, one of the top performers in the S&P 500 today. How do you look at this one, George?
Well, I think right now we're still seeing that narrow group of companies accelerate higher, and that's inclusive of Intel. We were seeing AMD higher today, as well as all the memory storage companies like Micron, Seagate, and SanDisk, and Western Digital. But nonetheless, I think the story for Intel is more in line with some of the cyclical aspects of artificial intelligence, but also the secular change shift the company's going through, especially its foundry division, which I think is quite valuable in the context of what's happening with the markets, with the secular trends in artificial intelligence and computing needs, but also policy. Policy catalysts are really embedded on reshoring or onshoring semiconductors, and Intel has always been a successful company here in the United States. When it comes down to its technologies, there are some challenges with its foundry business, but nonetheless, I think that's a positive catalyst for the online business going forward, because we know the administration is very pronounced on bringing back technology manufactured in the United States. Samsung, Taiwan Semiconductor, Intel are all expanding operations here, and I think Intel's going to benefit from that. If you look at the analysts, kind of a mixed bag today. HSBC did increase their target to $50 on the name from 26. Now they've got a rating from basically a reduced rating. The reason being is that valuation is still a little bit rich for Intel, but nonetheless they still see positive catalysts.
Then they can say you want to spend all the gas. He said I want to be the highest. So I want to spend the most money in Dallas on gas.
Memory demand is and storage. That's why we're seeing that narrow group of companies like Seagate, Micron move higher, and Intel's participating.
We're here to help your best bud live their best life, and that starts with the best nutrition.
So they've got a street high because
whether it's fresh, frozen, raw, or freeze-dried, Eater's Pet Supply stays stocked with the best brands for every budget. Not only is a raw diet packed with high-quality proteins, essential aminos, and healthy fats, fresh and natural ingredients also mean better digestion, healthier skin, and fewer allergies. Shop online or stop by your neighborhood Eater's Pet Supply to discover the best nutrition for your best bud.
What are you trying to do on that?
The challenge has really been the foundry business, which is getting support, not necessarily just from the administration, but also from major players like Taiwan Semi, NVIDIA, but also SoftBank. So for what it's worth, there's a lot of investment going into expanding Intel's foundry business. Last year was very telling because they took essentially an $11 billion asset impairment charge on their foundry business. And since then, if you look at the last 4 quarters relative to last year where they lost $8 billion, they're profitable again. I think that's very important in the context of the trend, as well as why some of these analysts are still relatively bullish.
Okay, so yes, you mentioned it got into the analysts that are relatively bullish. At the same time, you still have some on the sidelines. You make the point about Susquehanna, even though they've listed, they're still neutral on this. And then Wedbush is reiterating their neutral.
You're running up over there.
$30 price target. What is your thought on that?
So I think it's a manifestation of
the
trajectory. To be honest with you,
LHAI.
that's why again you're seeing the variance between the midpoint and even the low point analysts. Based on what I see today, $20 is the low, 65 the high.
Sound like a
It's quite a
truck.
large variance from low to high. So that gives you some idea that there's a lot more uncertainty associated with Intel. I know the trend is very positive, so you really can't discount that. And that could be both cyclical and secular. So I think it's a manifestation of how much progress they're making on expanding their domestic foundry business.
SOAR.
Things like tax credits will certainly help them. Tariffs, a lot of the uncertainty around geopolitical stuff is maybe beneficial to Intel.
You ain't lived it until you did it.
Base is really where again that more steady revenue base is going to come from. So for what it's worth, again, some analysts are neutral because if you look at this year's earnings right now, they're quite low. They're positive but low, 34 cents.
ACRS.
138 times this year's earnings. Next year, estimated earnings 61 cents. So
I didn't even know you guys were this weekend, brother.
Year over year, but still next year's forward.
Joe, you probably told Joe. You told Austin.
A little bit high, and that's why I think there's a little bit of a hang up from the
Austin, yeah.
Who are rather mixed. Some are being more conservative, others a little bit more aggressive. So it's going to be quarter to quarter for Intel going forward as they give us more developments on their foundry business as well as end customer demand.
All right, quarter to quarter. That's word. George Sellis, senior markets correspondent. Thank you, George. Let's get Tom back in here for the example trade. So, Tom, you heard the breakdown that George gave on Intel. What's the approach you're taking for an example trade?
Yeah, I
CRVS.
mean, this stock, it's gone parabolic, you know, since
You got too much on your mind at the time, my boy.
early fall on this name. I mean, you got to think about this. This stock was trading 1760, and that was, you know, probably about 10 months ago, 9 months ago. So it's had
Or
a
hurt
great
somebody.
George mentioned the investments.
Or hurt
whether
somebody.
It's Nvidia with $5 billion, it's SoftBank with $2.5 billion, the government stake of nearly 10%. That's piqued a lot of interest in this one. So I looked at a strategy that maybe maybe the parabolic move might be over, but this is about the strategy. Directionally, I'm going bearish on this one.
Nigga, that's on the liability card, nigga. You fine.
Easily flip this strategy into
They ain't have to break the
downside.
bank. Nigga, they ain't have to break the bank that much, nigga. You good.
Strategy and the implied volatility level.
You know what I'm saying? It ain't like they fixing. It ain't like they fixing they shit, and it's gonna go right back down after that 6-month period. And you know that, so shut your ass up. I know you talk to the fucking people. Yeah, they told your ass if you stay straight that you will be fine, right? I'm sure they. Cause you ain't. This your first accident, it was, wasn't it? Your first wreck. Yeah.
That's the cheat sheet.
On a $5 wide, so you're paying about half the width of this put diagonal. Now, if you pay that $2.5.
You see, for me, it wasn't like that. See, like, I had to let years go by with my old ass. I done been in wrecks. So, I had to let years go by for them to not even look at my shits as wrecks. But they just don't give me that low rate like they would give somebody who never been in a wreck and let's say they 30 years old type of shit. They won't give me. So, exactly. So, whereas though my shit start like at a 97 because I done been in shit. You get what I'm saying? I kind of fuck the odds up on my shit because I done been in wrecks. You get what I mean? So, but $97 is still cheap compared to other motherfuckers having to pay who in recent wrecks got he's like 150. Yeah, 300. 300. Yes. Yeah. Bro, that the reason why I was telling him I paid $300 for the SRT is because it's a fucking SRT. That's why I'm paying that for that shit. I had paid some fucking simple as $90, bro. $90, $97. Your shit is. Nah, your shit gonna go up. It's gonna go up to like $80. You get what I'm saying, Cohiba? It ain't gonna go up crazy. But then, like I said, after the 6 months, you will be straight. Then let your ass get into a motherfucking another wreck. Then that shit gonna go up to $80 to $90. And then it's not gonna come down like how my shit don't come down. You get what I mean? Even though after the years, it keep going down. Like after the 5-year mark, you wouldn't get into those situations, it go down. Like I ain't been into a wreck since shit, Cohiba. Mine wasn't even wrecks, it was the speeding tickets. Yeah, speeding tickets. So mine wasn't necessarily the wreck because if you want to get technical, I only been in like 2 wrecks. When I was 18 on paper. So once when I was 18, I was in a wreck, and then once when I was in another wreck in 2007. A long time, yeah. It's the speeding tickets for me, yeah.
Investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
CRVS.
Bro, and also like we just said, when you got a lot of shit going on and you got a lot of shit on your mind and you not really focused, you trying to do a bunch of other shit like that happen, bro. It's really yo, just imagine it like this. What if the angels around you let you take that little small wreck just to wake you up, to let you know it could have been something worse? You get what I'm saying? What if your angels was on some shit like that, like, yo, nigga, this shit happened, but it could have been worse type shit.
One of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Last year, my dad had
CRVS.
a big shock to see this person that I've always seen as a force in our family be vulnerable.
This bitch here want to sit here and fight me and shit because I don't want to be with her no more. Bitch, you just want to have to deal with it.
He's been with Schwab for a long time.
Jim, my financial consultant. I probably met 20 years ago.
Jim's really been there to answer any questions I ever
You know,
have.
son. Oh, I don't like being around you either. I'm like, bitch, you don't got to be. You got a whole father, you got a sister.
Actionable data
You
and
don't gotta
market
be
moving
around me.
analysis. Schwab Network connects the headlines to the why in real
Exactly.
time. Watch free 24/7 at
CRVS.
We love you, nice. Chill up. She want another baby from you, G.
She ain't getting one either.
Nice. She ain't getting one either. Yeah. Nigga nice says she ain't getting one either.
XAIR.
Has she mentioned that though?
Mm-hmm. And yeah, bro, it be like that. They forced it upon your hand.
Has agreed
My
to
bad.
join us for 15, 20 minutes or so. KG, senior markets correspondent, of course, for the Schwab Network. You know, Kevin, it's a stock-specific show. We're going to spend a lot of time talking about some of
CRVS.
these stories, but
XAIR.
let's start big picture, I believe, on a day when the S&P 500
Huh?
is down over 100 points, NASDAQ
I did.
down 400 points. What do you make
I told you I got two. I got enough for you. What's up? You ain't that already.
JFDR.
Oh, shit, just pull up, let me know. This shit's smoking good too, like a motherfucker, boy. This shit hitting. I'm about to blow right now. On break.
SHPH.
On break.
IBA.
Well, it's one of those things where there's not a lot of bright areas
ACRS.
of the market today, but you know we've talked about this before. When you have a market that's got essentially all-time highs, relatively compressed implied volatility, in some cases it doesn't take much, and that's not to dismiss the geopolitical headlines. That's not to dismiss headlines that may come out of Davos and threats of tariffs and the things that happen. But in the context of where we began, you know, it wouldn't probably have taken much for a day like this. Now, what investors and market bulls want to make sure happens is that this relatively, I would say significant sell-off doesn't become something far greater, similar to what you saw almost a year ago, last year in tariff tantrum 1.0, if we do enter a tariff tantrum maybe 2.0. So, KG, I guess the bright spot today is that is it worse? I suppose you still got about a quarter of the S&P 500 higher on a day where the Magnificent Seven as a bunch is essentially 7 for 7 lower, down over 2%. It's going to be really, really difficult for the market to have a good day in that backdrop. So sometimes you just got to hang on and see what happens.
Yeah, I would agree. Actually, the setup going into earnings, too, could be actually very interesting for a lot of these technology stocks like a Microsoft that has already kind of sold off into those earnings announcements, taking some of that premium or that froth out of the multiple here. And maybe it does set them up for a decent reaction to the upside once they do report, and if the fundamentals kind of align and beat or even exceed the street's expectations.
ADTX.
volatility. I mean, last week of December we had a 13 and a half, maybe even a 14 VIX. It's a lot harder to actually move that VIX to the downside than it is to kind of re-rate that a little bit higher. And I think that's what we're seeing right now. Maybe the big wild card that we do have in the next 24 to 48 hours, a couple of them. Japanese yields, let's see if those continue to blow out to the upside. We are expected to see maybe some commentary on the financials.
Uh-oh. What you doing? Making popcorn?
President Trump. And then I think the wild card is President Trump's comments about
ADTX.
I think that probably will cause a lot of volatility in the market here. But this might actually be a really decent setup leading up to the Max 7 earnings for the next couple of months.
Yeah, 8 of 11 sectors still higher on the year, so year to date. The S&P 500 is now down slightly, but let's call it unchanged year to date. So you know that you have IT.
Going out there, man.
ACRS is now a little bit of a drag, and that's going to be a big weighting within that index. So a huge portion of why
ADTX.
to settle in. But we're now 3 weeks into the year. Given how we closed last year, still a pretty good start, all things considered. Ken, last thought though, before we get into some of these stock stories, it's kind of a sell U.S. story. You got dollar down, you got Treasury is lower, you got obviously U.S. stocks lower, we talked about, but you got the metals surging. Bitcoin though not participating. To me, this is more traditional risk off.
ADTX.
Less bright areas like Bitcoin's been performing okay in some of these geopolitical spats recently, not today.
ADTX.
Yeah, I don't know. I would, I don't think it's actually that traditional. I mean, to see dollar down, yields higher, and equity markets lower, we usually do not get that type of correlation. At least one of the three buckets actually does see some positive performance in a good way, right, to show and reflect that risk-off sentiment. We're not seeing that right now, but we also do not see that actually
ADTX.
lasting for too long. And in fact, the last time that we saw something that had duration, where yields were moving to the upside, meaning bonds were actually being sold off, dollar moving to the downside, equities moving to the downside with the tariff tantrum, and we actually had that for like 4 days, 5 days, and then we saw the White House actually kind of readjust their stance when it came to tariffs to try to provide some clarity, and that led up to that big rally up the April lows, and then once again we just started making new all-time highs a couple of months after that. So this is a one-day event. I think right now you go back to the technicals, questioning this market, you go back to the technicals, look what's actually working right now. Small caps actually performing relatively well today. I thought that's actually very interesting. In the agricultural sector, if you're looking at some of those stocks, have been actually in a little bit more of a bull market. That's actually performing as well. So I think it's going to be a pick and choose type of market here. And if you get a correlation of dollar down, yields higher, equities lower for the same week, I think that we probably have a bigger problem. We're just not there yet to really confirm.
Yeah, well said. I guess I meant kind of
ADTX.
risk off, but yeah, I'm with you. Normally we would see treasuries spiking at the least if this was, a real safety, fleet of safety type of a trade. But all right, let's get into some of these stories. Big show plan. We're going to chart and trade some airline stocks in next segment. We'll get to some of our movers in a moment. FOMO, we're going to talk some Netflix as Marley Caden's going to join me. And then pharmaceutical company CRVS, big move today on some drug trial updates. We'll do that for under 30.
ADTX.
Service. So looking forward to that. KG SanDisk. I mean, this stock has been incredible, and it's incredible once again. I know there's news driving some of the movement again, but at some point you just gotta take a step back and almost be in awe when you see this type of a move.
Yeah, this is a free trade and continuing to move to the upside. Kind of reminds me of silver. Now we continue to see a lot of analysts actually chasing the price action here, re-rating their target to the upside.
ADTX.
For the name. It looks like Citi actually adjusted their price target higher, up to $490. That's up from $280. That's actually a remarkable move to the upside, keeping their buy rating in the shares. Once again, kind of talking about the demand that they are seeing in hardware here in the near term, also potentially expanding out margins. We continue to see analysts kind of make these adjustments. What makes it kind of interesting, Alex, is this going to be sustainable? We saw the same type of situation when it came to Oracle. Once Oracle started hitting those highs, all of these analysts started to re-rate their price targets aggressively higher, $150, $200 higher, and then that was kind of the peak in that cycle. I'm not sure if we're there yet. You probably would need to have a announcement or something that does not really shock the street to the upside in order to re-rate this aggressively lower here, but making higher highs, higher lows, technical signal still says that this is a bull trend.
Yeah, and when you look at something like I'll look at a 5-day EMA, KG, especially in these really like momentum-driven names, and it's essentially been almost like a wave for this stock. Every time it has a little bit of intraday pressure, it finds that level seemingly and bounces from there. So the stock opens a little bit lower today, basically right at that 1-week EMA, and then it's off to the races once again. So big move as the winner of 2025, short-term wise is already a big winner in 2026. As I look year to date, it's by far the best performer already. This stock is up 87% year to date. Like, that's incredible. That's a decade for some asset classes. So, we're making a big deal out of the move in gold. I mean, basically SanDisk has done that in the last 3 weeks. So big time stuff out of the chip maker. Let's talk ServiceNow. Not a name we talk about a lot, Kevin, but these software names have been a mixed bag, and mixed bag ServiceNow has certainly been, as it's on the downside again. It's lost almost half its value in the last 52 weeks.
Yeah, this one is pretty much, it's almost round tripped here if you're looking at the lows that we saw back in 2023 here. That's sitting at around 106. Stock's trading at around 127 right now. You continue to have some bearish commentary around the software names just in general. Adobe seeing the same type of move to the downside. This concern that artificial intelligence is going to squeeze their margins, which, on the outset, a year ago, 2 years ago, you could make that case. Kind of makes sense here. And now a lot of these companies are starting to re-rate a little bit lower. Now, the one thing that's actually very interesting, ServiceNow is actually one of the first software companies to actually monetize artificial intelligence at scale outside of maybe Microsoft. And so you're not seeing a lot of fanfare for this name. You had UBS actually cutting the price target, $260. That's down from $275 to keep their buy rating on the shares. But I think technically speaking, Alex, until you get to around that, I mean, you could maybe make the case for a shot right now, but I think if you go back and look at around that 105-ish area,
ATTX.
probably you get a little bit more comfortable to try to play the bounce to the upside here, rather than maybe continuing to see this fade. But software names just in general across the board have gotten hammered here. I'm not sure if that's going to last for too long.
Yeah, at some point, some of these elevated valuations, maybe 3-4 years ago when software was the hot trade, have certainly been repriced. But you brought up a good point. It's something that Jenny and I have talked about quite a bit over the last year plus.
ATTX.
You used Adobe, so I'll welcome Adobe into the conversation as part of my explanation. But it's almost as if AI just took a trade that was super consistent and reliable and just increased the volatility of outcomes. Like, Adobe might be an AI winner, but it might be an AI casualty, where 3 or 4 years ago, it was a consistent recurring revenue stream that investors could trust, best-in-class software. And those are just different, assessments for investors. And I think that's software broadly right now. Unless you can really show how AI is either making you a winner or you're insulated from disruption, there's just a lot more questions in some of these cases than there are answers. Combine that with elevated valuations coming into it, it was sort of a recipe for a big repricing. Thoughts?
Yeah, no, I completely agree with you. I got two things to kind of say with that. First, this cycle, when it comes to the software names and artificial intelligence, kind of reminds me of Microsoft and like Linux, right? The operating systems, where Linux is great, there's a lot of packages with it. It's really utilizing back-end processes, right? Running servers and things of that nature. Microsoft kind of focuses more on the corporate front-end portion. That's where the margins are. Artificial intelligence is kind of looking like that right now when you're looking at LLMs. I mean, there's a lot of competition out in this space. China also has a lot of open source software as well. So it's going to make it a lot more difficult in order to monetize this business. That being said, these valuations, I would not be surprised, Alex, given the interest rate environment. Let's see if we get some more cuts. Maybe 10-year kind of settles out here a little bit. A lot of these software names continue to move lower. You can make the case that this could be an M&A type of industry here this year, just given the fact that a lot of these stocks have aggressively sold off, and maybe we see some consolidation, maybe even for some of the mega cap names that want to pick up some stocks and get some exposure here. I know we're not talking about it, but it looks very interesting at 275. Pretty much the COVID lows, or not the COVID lows.
ATTX.
Hey, a little bonus mover in the case of Adobe, but let's get into some of these earnings. So you talked about the importance of the setup into
ADTX. XAIR.
This has been a trade that's been a little, I think investors have been a little bit more open to in the last 6 months.
NTLA.
Yeah, and this is a tough business. So 3M, if you're kind of looking at their portfolio, you could actually still make the case that they actually have a lot of strength here. If you're looking at the onboarding of building out infrastructure in the fabs and the factories for Apple, I mean, 3M is going to have exposure to that. You also have the healthcare sector; they have exposure there. We did see the company actually post PFAS business, if you will. It's more of an environmental situation that they're kind of going through. They're divesting away from that. They're still taking some write-downs there. I think if you look at the industrial space, there's still a lot of opportunity just as a whole here. I just think 3M right now is just experiencing a little bit more headwinds when it comes to margin.
ADTX.
And the market's kind of selling off on that.
SHPH.
From a technical standpoint, though, you can make the case that it's getting very close to a key level of support here, that we're pretty much filling this trend line if you're looking at the weekly chart, and you're looking at around that 148, 150-ish area.
NVAX.
That's area of support here. So not a bad
Bro, we need some space.
guidance, a little bit light. You can still make the case
Damn, bro.
demand picture and story for 2026.
Yeah, no doubt that this area between about 145 and 155 has been significant in terms of a lot of price action over the last 52 weeks, kind of centering around
SHPH.
basically the lows of today, maybe like 152 or so, 152 and a half is sort of that center of that.
XAIR.
KG, I know this isn't unique to 3M, but for a stock that trades with a little bit lower implied volatility, maybe not in the fastest moving sector in the case of the industrials, earnings are really important. Like so much of the year's move happened on those 4 days when we get the results. You look back at
ADTX.
last quarter's earnings, big jump higher.
SHPH.
Today, kind of a big repricing to the downside. Essentially, that
That's
brings
all.
you back to square one from 3
Look
months
good,
ago.
though.
So the stock does a lot of going sideways, or at least it has over the last 52 weeks. And those earnings reports are really, really
SEGG.
important. So,
Kill him.
a little bit disappointment.
Fuck, I had to
Street here
fucking
today.
do it.
One has to wonder
Oh
how
my
much
god.
the overall
It's just
market
this.
weighing on things
I
too.
should have took the midi. My bad, yo.
Things out here with DR Horton. The stock opened lower. Kevin was able to recover and actually trading slightly higher. I thought these were, better than feared results. How did you frame them?
Yeah, the guidance came in a little bit light on the conference
Great.
call, which is why we saw the reversal. I mean, this thing has been gyrating. Before we came on, it was actually lower here, but the company did actually beat the street's expectations, both top, bottom line. They are kind of
ADTX.
guiding a little bit light when it comes to margins. They talk about expanding and increasing some of these incentives, basically buy down rates, try to keep the price of these homes relatively low, especially trying to get into
NTLA.
these homes in order to keep demand where it is right now. They're also probably seeing a little bit of pressure when it comes to new orders and backfilling the order backlog that they saw 12 months ago, which rightfully so. Obviously, there's been a lot of uncertainty here. This could be an industry, though. I mean, obviously, the stock, once again, gyrating. This could be one that does shock the street to the
SEGG.
upside at the latter half of this year, getting closer and closer to the midterm elections. Maybe housing affordability is definitely going to be on the ballot there, and there could be some initiatives from the White House in order to try to soften some of the housing market in some respects, especially for consumers, and DR Horton could actually be a beneficiary of that. What do you think?
Yeah, this is a tough space, and I think they said it well, basically saying, hey, buyers are still getting a little bit of sticker shock. We got to give them incentives. Well, those incentives showed up in the form of a margin, profit margin that came down 3 full percentage points year over year for this company. I mean, it's a tough business right now, but 3 full percentage points on profit margin going to warrant a little bit of a repricing, and the stock has been repriced just a little bit off its
HYMC.
high. All that to be said, though, Kevin, the stock's done pretty good on a
Corner.
long period of time. The home building
Yo,
space,
nigga,
the
I know how to
business.
pass shit.
Demand for homes still there. We know that it's complex, but even if some of those policies are enacted and whatever, at some point there's a demand, one would think, for homes and new construction like DR Horton and some of its peers. Final thoughts, big picture, DR Horton, any of the movers?
Yeah, I would say I think the biggest risk that you have for the new home builders is existing homes hitting the market. And if we do see interest rates going a little bit lower, that might get some individuals off the sidelines.
ADTX.
And that's where you start seeing a
ACRS.
little bit more pricing pressure,
SEGG.
competitiveness in this market, which really kind of went away right before COVID-19 and hasn't come back ever since. And so some of that data also may put a little bit of pressure on this name. You get concerned though if you see a break below this 140-ish area.
I'm not one of them.
That we start seeing a re-rating lower and it starts to break down. But once again, this is a very hot topic, and I would not be surprised
HYMC.
to see some adjustments.
DPRO.
Boost some of this demand here, not only in new homes, but
ADTX.
Always
ACRS.
a pleasure, my friend. Thanks so much for taking the time, and we'll catch up soon.
SEGG.
We're taking a short break. Time for Chartmaster. When we get back, we're going to be charting and trading a couple of the big-time airliners here in the U.S. We'll take a look at United Airlines as well as American Airlines. We're joined by Rick Ducat right after this.
DPRO.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Intern, this place is incredible. It's where I get all your office supplies. Your golf balls, your fancy coffee, your giant TV. It's everything in one place. It's like Schwab. Everything investors need, all in one place. Come again? Yeah, at Schwab they can do everything. Invest, trade, get full service wealth management, and anything in between. Think I'm gonna be sick. We have to buy that now. Schwab.
Invest your way with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen Investing. Alex Coffee. It's time for Chartmaster, joined by Rick Ducat, the market technician for the Schwab Network. Looking at some big airliners here. We heard from Delta. Now it's time to hear from everybody else. Well, let's talk United Airlines. Very unique looking chart here, Rick. What do you make of it?
Yeah, a bit of an unusual setup here, but what we have is a situation that is quite common. The overall situation of breaking out above a prior resistance level and then retesting it as support. What I mean by that is you can see here our green line. We had some old notable highs near that 110 level. That was about where we topped out again a second time, then a third time before the breakout. Now the breakout has retested that area. So as I said, old resistance has become new support, despite the rather unusual other setup here where we saw such a dramatic decline and then a failure to overtake those old highs. Now we are seeing...
Now, real quick, I just got to ask you guys. I know I said I wasn't going to do this.
Yo.
I see something here. Cup with handle, or is it too sharp of a move?
Hold on one second.
You could say that. You know, a lot of times I don't really put a lot of stock into very strict definitions. It's more the general behavior of what you're looking for. In this case, we had a long decline, perhaps a bit more sharp, as you say, than the traditional cup and handle. But what happened was that we made our way back up to the resistance. We saw the rejection. That would give us the handle type shape. And then eventually continuing on upward here. So again, if you want to really go with a microscope and do the exact way the pattern is supposed to work out, you're probably going to be disappointed pretty often. But the general ideas here of a gradual bottoming out before the trend continues, I could see the thinking behind that here. Nevertheless, here we are trending a little bit lower here, trending a little bit downward, but holding on at that support level. We can see we're crossover today. Our volume profile study shows that we have heavy volume here. Our point of control comes in just below 105, 104.42. Significant volume also here.
Representing sort of the end of this month, looking at the 110, 107 short put vertical dollar credit. If you're able to get that dollar credit, it's going to create a 2-to-1 risk reward. You're going to risk $200 with a chance to make 100, break even at 109. So relatively close to where the current share price is. Looking for more of that continuation, perhaps even if it does continue to test those bounds. Some of those trend indicators that Rick talked about are starting to indicate maybe a trend breakdown. Well, this doesn't need upside, just needs no downside. 2-to-1 risk reward, 109 break even, chance to make $100 in this example on the neutral to bullish short put vertical. So we switch back and bring back in Rick here. We're going to talk one of its major peers in American Airlines. Now, American hasn't had the same levels of success as some of its peers, given some of the debt situations over the last few years, but I would say similar looking chart.
Yeah, exactly. The general shape is pretty similar here with some pretty important differences, namely that we are not holding on above some of those old highs that we saw. Rather, in this case, it's more like we bumped up against a ceiling. You could say this small consolidation area that we saw before our downward plunge there, those old highs near 16, that's around where we topped out here. That was around where we formed a bottom near 15, and then to backtrack and look at 14 again, a brief consolidated phase during the decline translated into repeated high points there and then the subsequent break to the upside. So 16, 15, 14, nice easy numbers to remember here for this one today. But we can see as well our blue trend line, our upward sloping trend line has been broken. Now the shorter term white downward sloping trend line would be more what's in play, but sideways range bound activity heading into earnings, pretty common situation to see developing here. We did have again a downward crossover below that 50 midline here, but really these types of things I wouldn't put too terribly much emphasis on as we head into an event risk situation. But similar story to our last chart in terms of deterioration from our trend indicators, our moving averages, weekly crossing below the monthly EMAs again. They're both coming together around 1535 or so. That would be kind of the midpoint between them. So that would be a notable resistance cluster to watch if the bulls can overcome. It lines up pretty closely with our short-term trend line as well. So perhaps even another set of indicators coming together for that, the trend line plus the moving averages here. Volume, we can see nodes here. There's kind of two little pockets here, but generally around 1550 is where the heaviest activity is. Another pocket here near 17. That could be another speed bump to the upside. Meanwhile, things pick up significantly around 13. So 13 to 15, pretty light trading. You could see fast-moving prices in those areas.
Rick Ducat, always appreciated the technical look at American Airlines as we shift over to the big screen here and talk example trades. You know, not a lot of excitement in the technicals. That said, there wasn't a lot once you get through those resistance points to the upside. So perhaps a little bit thinner air, and this stock could be off to the races if it does break through that 15 and 16 resistance levels that Rick talked about. So that's what we looked at here. It's a February 20th long call. So just buying the call. It's a risk-defined strategy, but it's not profit-defined. And so at the money, 15 call going out to the February 20th cycle, looking to spend $1. Now your break-even will be at that 16 resistance point. So you'll have to get through 15, get through 16 just to break even. But if you do, it can go off to the races there and then potentially unlimited profitability. So who's to say if that would happen? It is risk defined in the event that it doesn't, but it really could pay off big in this example if American Airlines does start to move significantly higher. It's going to do it for this segment.
after the close, we got Netflix earnings, big-time tech company, big-time earnings release. That'll be the subject for FOMO. We'll be right back.
For instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets, follow me on X at @NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The two grandchildren planning for their college educations. Someday it'll be their turn.
Welcome back to Next Gen Investing. Alex Coffey, now joined by Marley Caden, host of Market on Close here on the Schwab Network. Make sure to check that out. Netflix is the discussion here for our FOMO segment. And I couldn't think of a more fitting name. It's doing pretty good in the face of some disappointment across the board today. It's got big earnings, and it's got a news story. Let's start with the news story. Some of this telegraphed, I think, late last week, but confirmation now over the weekend.
Yeah, we heard rumors that we might be getting an update to their offer for Warner Brothers Discovery to try to potentially speed along the acquisition process. We did, in fact, get that update today that they have amended their offer to buy Warner Brothers Discovery to now be an all-cash offer. So now they're planning to pay $27.75 per share entirely in cash to acquire the streaming platform, HBO Max, as well as the Warner Brothers Film Studio. The two companies reached this deal, this merger agreement, back in December. Then it was composed of cash and stock at an equity value of about $72 billion. Now, with this change to all cash, the expectation is that the shareholder approval could shift to as early as late February, so late next month, early March. Previously, shareholders were expected to vote on the deal in the spring or the early summer. Also important to note that Warner Brothers also filed its own preliminary proxy statement seeking shareholder approval for the deal with Netflix today. So if that deal does get approved, they would be able to spin off their TV networks, which is not a part of Netflix's offer, into that entirely new publicly traded entity known as Discovery Global. That should take roughly 6 to 9 months, Alex, and then the Netflix deal would close once that was done. But again, as you well know, there is another suitor in this story, a very aggressive suitor in Paramount, Skydance. So we have, yet to hear the response from them, but as of last week, they had filed a lawsuit trying to get Netflix to disclose the terms of their offer. Now the terms are all cash. That lawsuit was actually denied by a Delaware court judge. They could not expedite
At least the expedition. Of it. Yeah. So I think now it's clear Netflix is just trying to get this across the finish line. I think the gray area is, what do you want to value those TV networks, because that can be a discrepancy. But it still comes down to, the Paramount deal, the questions around the financing. And of course, there's the breakup fees with the Netflix. I mean, Netflix has the financing secured at this point.
They did boost that bridge loan facility, adding $8.2 billion to it from Wells Fargo and a few other banks to help finalize this. But it seems like it's all heading towards this happening. There'll be regulatory hurdles, and of course, Paramount doesn't seem like it's going to go down without a fight. But that might be a story for tomorrow. The story for today is going to be earnings after the close. Now, I don't doubt that a big part of the conference call will center around this deal. But before we get there, we're going to get a press release. We're going to get some numbers. You'll be breaking those live. What are the expectations?
Expectations are for earnings to be up about 28% year over year. That'll be at 55 cents a share. Revenue expected to come in just below $12 billion. That would be 17% year over year growth. So double-digit year over year growth, both top and bottom line. But as this Warner Brothers Discovery saga has been going on, Netflix shares have fallen about 15% just since announcing that they had won the acquisition process on December 5th. So really weighing on their near-term trajectory here. As you mentioned, it will likely be a focus of the call. Another thing that will be highly in focus is any of their ad numbers, their ad-supported tier and pricing power. Ad revenue is becoming a much more meaningful part of their business. Retention in that segment will also be an important thing that's in focus. We don't get any quarterly subscriber numbers anymore, Alex. They don't do that anymore. So anything on engagement metrics, on churn trends, content performance, specific titles or areas where they see growth, particularly following any major releases, some of those holiday releases particularly, could be really important. And also this gaming. They have this gaming initiative. It continues to be a hotly debated component of their growth, but one that Netflix is continuously backing.
So much IP in this deal if they were to get that from games.
And if they get this Warner Brothers with all of those titles, that certainly would help with the build out of what they're trying to do in terms of removing friction in the gaming space the way they did in the streaming space. But again, it's another somewhat uncertain path. A lot of it's tied to an uncertain path right now because, as you mentioned, the trajectory unclear with Paramount Skydance being a very aggressive third party in this process, but also regulatory concerns. Even if they get shareholder approval, there's no guarantee that this deal is going to go through. So I think gaming, ad numbers, any sort of user metrics that tie to subscriber numbers in some meaningful way, or anything material in terms of this acquisition deal that we aren't already aware of, I think will be really important comments and also potential catalysts here.
Yeah, no, a couple thoughts on that is, some of it's going to be your sort of the read between the lines on how they phrase things. It's similar to what we do with the Fed statement, right? What words did they use last time? How do they describe it now? They might be forthcoming on some of these metrics, but no promise for any of them. But I love the gaming call out because to me what that says is it tells you, it's Netflix telling you and us who they feel their competitors are for eyeballs. It's not just Paramount or Comcast or any of these other studios. It's on the phone, it's on the iPad, it's on the Xbox or the PlayStation, the PC. It's any time spent doing something else, and they want to build out this holistic, vertically integrated company that basically controls our leisure time, I guess. So we'll see if they succeed or not, but I'm looking forward to this. It always sets the tone for big tech as well. I think about a 7% move is the last expectation that I had seen as well. So big time volatility expected again for Netflix, which has been under pressure. Quick look at an example trade despite that maybe more elevated implied volatility. I actually looked at an example that is fading that implied volatility, looking for a more range-bound reaction to the Netflix results. And so with that in mind, it's an iron condor spread selling both a put vertical below the market and a call vertical above the market. $3 wide on both sides, expiring at the end of the week. So the short strikes in this case are the 95 and the 82. 95 call, 82 put. So looking for it to stay between those two levels. $3 wide wings and $1 credit received. Creates a 2-to-1 risk reward and break evens between 81 and 96. Again, max profit 100, max loss 200. Thanks to Marley Caden as always for the update on the deal as well as a quick earnings preview. Make sure check out Marley later on, market on close, as they break these earnings live. We're gonna take a short break. When we get back, time to talk one of the fastest growing digital companies in the world. Find out more right after this.
got your smile.
Carl.
Yep, your #1 broker's here to welcome your new little dependent.
Actually, we invest with Schwab now. They have everything we need all in one place.
I can set up her college fund.
I've been learning about new trading strategies.
Schwab helps me generate retirement income.
All this Schwab as everything you need is making me cranky.
Does somebody need a nap?
Schwab!
Invest your way with Schwab.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are. Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Welcome back. Time for a developing story. Joining us now, Diane King Hall, the host of Morning Movers here on the Schwab Network, and joining us from the New York Stock Exchange here to discuss Intel. Big story of last year, continuing to be a big story in 2026 as well. Couple analyst moves. What were they?
Yeah, you definitely have some analyst moves around this one that's adding to the overall bullish sentiment that we've seen around Intel so far this year. So you are seeing shares rise about 3% now. It's off the highs of the session, but still one of the best performers in the S&P 500, especially when you look at a heat map, where it being a sea of red on Wall Street today. Intel, one of the standouts. Adding to the advance, you mentioned the moves that we've seen from last year. If you think about this year, we're just, 3 weeks into this year, and the stock is up more than 30% right now. And if you go back over the past several months, it's basically doubled since September, but over the past 6 months, it's had this really strong upswing. You have more and more analysts becoming bullish around this one. The vast majority of analysts still in the hold camp, still in wait-and-see mode. But Seaport, one of those turning more bullish on Intel today. Seaport has upgraded it to a buy. They've got a $65 price target on Intel now. They say Intel can retake market share in enterprise CPUs, consumer PCUs. They're seeing strong feedback from PC makers, especially after CES. They've raised their 2026 revenue outlook. They've boosted their adjusted EPS estimate to between 69 cents to 65 cents. Seaport thinks that Intel is becoming viable again as both a product company and a manufacturer. HSBC is upgrading its view. Now, it's upgrading its view to the sidelines. They moved to a hold. Essentially, before this, they were like, we're out on this one. They've doubled their price target to 50, though. They're expecting server CPU shipments to rise 15 to 20% this year. They talk about agentic AI as a big catalyst for Intel as well. They think we're going to see renewed demand for traditional server CPUs as well, and then an increase in Intel's foundry. We've had this conversation. The tech story here is all about Panther Lake and its 18A process, and that's been a tailwind for the company recently. So again, you have momentum that is going against the grain today in the overall price action. Alex.
Diane King Hall, it is always a pleasure. Thank you so much for the update. As we say goodbye to Diane, we welcome in our next guest, and that is Ben Parks, the head of advisory services for SimilarWeb. And Ben, good afternoon to you. You guys just released, I think in the last couple hours, your SimilarWeb Digital 100 report for 2025. Let's start big takeaways. What was the kind of the key themes that stuck out this year?
Yeah, good afternoon. So our D100 report launched today, and it's across 3 key areas. So it's on web, it's on app, and now on Gen AI. So many people are asking about Gen AI, and ChatGPT was one of the real stars of this year. Despite already being so big going into 2025, it really dominated across app, on web, and also in the Gen AI space. So a real big trend there. And what it's leaning into is this trend of utility and people starting to use apps and websites really to hone their professional and personal lives.
And I'm seeing in there, ChatGPT leads the top 10 with web visitors broadly almost increasing 10% year over year as well. That number looks closer to 57.5%, it looks like, for ChatGPT. But there's also some others on there that I think are quite interesting. You see TikTok continues to grow at a fast pace. Disney Plus might be a surprise to some. Perhaps some of those Taylor Swift releases help that. You also see AliExpress as well as Temu still on there as well. When you look across some of the other categories that you're following, what were some of the other standouts? I saw some weakness maybe in apparel. Was there anything else worthy of calling out?
Interesting. We saw some real surges in companies like Comfort. So they saw a real good year this year. They actually tripled their traffic growth. And one of the interesting things about them is they really like mobile. I think 90% of their traffic came from mobile. They really leaned into Instagram, as you can imagine, and also referral traffic. Another big trend we saw was productivity. So we saw a real switch towards some smart homes. We saw people monetizing their steps with WeWood. Those also came through as big trends as people kind of moved from maybe some more of the fun and gaming into really honing their lives and productivity, both apps and websites.
When you start looking at app downloads, it looks like app downloads broadly in some of these categories actually went down year to date, particularly like media and entertainment, for example. It shows a 2% decline in apps. Is that because of a lack of innovation in some cases, a saturation in your mind in some of these markets, or is it just general app fatigue maybe?
I think apps are as popular as ever, but I think also people are really thinking about how they spend their time and where they spend their time. So maybe there's some consolidation in terms of what apps they're using. And we saw it with the rise of apps in the fitness space. People were really leaning into kind of the home app fitness space. Like Runner, we saw really surging, 7-minute workouts. So I think people are kind of very cautious about how you use their time. Maybe some of that is showing in the app trends.
One of the big themes towards the end of the year, Ben, was this closing of the gap of maybe the other big AI players and ChatGPT, which certainly got out in front as sort of a launching of the AGI or just the general AI names. It looks like Gemini kind of showed up in your data as well. Gemini, of course, Alphabet's platform, really was getting a lot of love from investors towards the end of the year. It looks like your data supports some of that.
Definitely. I mean, Gemini is definitely one to watch for this year. You've seen the announcements coming out actually in the last couple of weeks around moving into the more commerce space with their partnerships with Walmart. I think Gemini is really going to accelerate the adoption this year, and we're starting to see it come into the data.
Grok in third, Claude, Perplexity, and Meta's platforms all in the top 6. So it's sort of the who's who when it comes to those AI emerging players. 77% increase in visits, 65% unique visitors as well. So it shows so much of that growth is, organic growth of just new people stepping into some of these platforms as well. But as we look kind of big picture and you tie in, what is the commonality that you're seeing across all these different subsectors and types of companies? You're looking at web, you're looking at app, you're looking at AI. What are the things that some of the fastest growing digital companies are doing that are in common?
Yeah, I mean, ultimately they're following where the eyeballs are going. So they're really understanding exactly where their consumer going and offering something that really delights their consumer. We talked about utility earlier and really optimizing people's lives for productivity. Those winners are really playing in that space, and fundamentally they understand their market, whether it's social, whether it's on affiliates, wherever it is, they know where to go after. So we're seeing that come through as a core trend this year. And as I mentioned earlier, people are really optimizing where they spend their time, and that's a key theme we're seeing in our data.
All right, Ben, final question for you. Taking what we learned from this report and all the work that you guys put in to get this report out, what is some sort of early, I guess, a look towards 2026? If you were to kind of think, hey, we're releasing this report a year from now, some of the trends you think might emerge in 2026?
Earlier, we're going to see a real acceleration of Gemini. I think the big thing for AI we're going to see this year is people going from discovery and kind of trying it last year into real adoption into how they actually purchase products and really move forward in this space. So I think that'll be a big trend this year. I think entertainment's going to be very interesting to watch about how people really spend their time going forward this year. And ultimately, it's going to be around how we can think about the actual channels of people getting there and really optimize for the brands. So the big use case for this for many of our clients is really understanding how to reverse engineer the strategies of those winning. So that's definitely something exciting for us to look forward to in the year ahead.
I'm looking forward to it. In a year from now, we'll see how different things are and how much the same they are as well. Ben Parks, always appreciate the head of advisory services for SimilarWeb with the update in the report, the Digital 100 report. We're going to take a short break. We get back, time for Under 30. Corvus, as the pharmaceuticals certainly on the move today. George Tillis with the latest as to why right after this.
Opportunities don't stop when the market day ends. so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on schwabnetwork.com.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to the markets with Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com
and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Next Year Investing. It's time for Under 30 as we bring in George Tillis, Senior Markets Correspondent for the Schwab Network. And George, we're discussing Corvus. This is a stock ticker CRVS, and it's making a big-time move, as many of these pharmaceutical biotech firms do around these trial updates. Positive results, phase 1 clinical trial. I'm not going to even pretend to try to know how to say the name of the drug. I'll leave that to you, George, but talk to us about what we found out.
Yeah, I'm not going to even try to pronounce it there, Alex, but nonetheless, I think, interesting situation. Markets, are struggling right now. There's a small cohort of stocks in the semiconductor space are doing well, and there's also going to always be some runners, and this is one of the runners today associated with a down market, but this is an interesting company. It's basically a biotech company. They essentially have some drugs that are associated with things like atopic dermatitis, things like eczema, which are skin disorder, but they're also moving into phase 2 trials for things like renal cancers as well as things like small cell lung cancer. So it's an oncology play too, but the market's latching on to good news, and there was certainly some good news for the company today, which essentially had an 8-week trial that was a small cohort of about 12 patients that came out very positive in terms of their eczema drug, which then places them in the position to move into phase 2 and 3, which are going to be longer-term trials, about 26 weeks, including a cohort now of about 200 patients. So really good step in the right direction for the business, which in and of itself, if you look at the stock price action today, is quite high, considering the positive news, as well as the fact that they've got some other positive catalysts in 2026 associated with, like I mentioned, with their oncology pipeline.
George, I always say that of all the different spaces that we cover and investors are looking at, this one in many ways is the most complex. There's just so much information that's so technical that you got to know. But there are analysts that cover this space and are really in the weeds here. It seems like across the board today, those who updated their information based off this were very, very happy with what they saw, and in some cases boosted their price targets pretty significantly.
Yeah, so that's the thing. So a couple things to point out. I mean, first off, the company hasn't generated any sales yet, so that's meaningful. The other thing is, if you look at the market cap at $600 million, they have about $66 million in cash. That's important because they're on a burn rate or run rate of burn around $15 million per year. So they've got plenty of cash to work with. They're also, for those who are looking for some secondary dilution risk, they're already in the process of a $100 million offering offering, which began back in September of last year. So they've got plenty of working capital to go with. I think the news is positive. I think the short interest too, which is around 16% of the free float, is creating a problem for short investors considering the news today. But at the same time, the analysts that cover the stock have quite a wide range. You got H.C. Wainwright increase their target to $27. So they have a street high right now, which was 24 yesterday or Friday, for that matter. If you look at the low target, it's around 11. In fact, if you look at the price action today, up around $11, it's already trading quite a bit above the low target near the higher end of these ranges, 7 analysts. So right now, very positive outcomes. There's also an element of a short squeeze going on in this name. There's a possibility they come to the table with additional offerings, but nonetheless, the trend in the last year has been quite positive. It's not just a day move. If you look at the trend that on the stock going back to April of last year, it's been moving since then. It just happens to be in a gap position today, which could backfill. You have to keep that in mind. But a very good outcome for the company, at least on a phase 1 basis. And as they move into phase 2 and 3, those are a little bit more tedious tests. We'll see if they have a positive outcome as a result of those.
Yeah, up a casual 140%. I'd say a pretty good day indeed, Mr. Tillis. Thanks as always, George Tillis. It's going to do it for us here on Next Gen Investing. The watch list is up next. See you tomorrow.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing of houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Exchange on the cover of Corner Wall and Broad, where we are seeing session lows right now. A sell-off has been underway all day long, and we have a big show for you today, because what is the market outlook after a day like today where you're seeing some serious selling and global bonds selling off? What are some of the key investment themes that can work for your portfolio? We'll talk about that. Also, technology. Some love it, some don't. A tech reset. Maybe there is some AI accountability that's happening. I'll talk about some of the facts that people love it and some that are worried about an AI value trap. And our panel ready to dig into all things Netflix. Now, of course, we have Netflix reporting its earnings after the bell today. Options traders are trading really guessing about a 7% swing either way. At the same time, we have the big Netflix Warner Brothers deal that we'll go into as well. Here's a quick look at the market. So this morning we woke up and we saw the selling underway. The Dow was down over 800 points this morning, and we're pretty much around the same area that we were early this morning. We tried to make a comeback, but you do have the president speaking. You do have concerns about tariffs on the rise for Denmark, Norway, Germany, UK, Finland, the Netherlands, and so on. And it's pressuring the markets. The markets are uncertain, and the VIX is back to 20. So here are the numbers: 68.13 on the S&P, down 1.8%. The Nasdaq's down 459 points, down 1.8%. The Dow down over 1.5%, losing 827 points, 48,531. And the Russell small caps, well, that's the best of the bunch right now, down 1%. Oil and gold, well, oil's up. It's at 60.42. Oil's been up 4 weeks in a row, but it's gold that's really the story here. 47.63. These are new highs for gold and silver today, the safe haven of these precious metals, up $167 today. Bitcoin right now, 89,500, down 6.5%. And as we're seeing precious metals gaining, the dollar is weaker at 98.33. Kevin Green, senior markets correspondent, is with me, and we're taking a look at this sell-off that's underway. And we started to see some bright spots as far as sectors. I know you're taking a look at NVIDIA, but tech overall, financials, real estate, a lot of down arrows. What's the NVIDIA story here that stands out?
Good afternoon, Nicole. Yeah, we are seeing NVIDIA move to the downside, down about 3.5%, close to 3.5% at this point in time. There was a news report that a Taiwanese server maker, Inventec, is stating that China is pretty much holding up these H200 chips, and it's pretty much the ball is in their court in order to allow the H200s to flow into China. Now, we know that the U.S. is now given the formal approval in order for NVIDIA to be able to export those H200s to China, but it seems like there's still a little bit of a holdup here, which could actually have an impact on their revenue moving forward, and then also could have an impact on some of these other downstream players like Inventec, or even if you're looking at a Taiwan Semiconductor for that matter. So you are seeing NVIDIA shares pulling back here, trading close to that $180 level. Keep your eye out on this. This has been a key area of support, but we continue to get this back and forth between the U.S. and China. It doesn't seem like this issue has been resolved. China is obviously on the position of national security, as well as trying to be a little bit more dependent on domestic supplies when it comes to artificial intelligence products like GPUs and CPUs. So it seems like we're still in a little bit of limbo here. NVIDIA continues to consolidate over the last couple of weeks. We have not been able to break above that 190. We have not broken below the 170 as well, though, Nicole. So keep your eye out on 180. That should be a key area of support for us here over the next couple of days.
Yeah, and look, I mean, Dan Ives today he has the Ives ETF filled with all the AI-related names, and he was saying, look, there really could be some opportunities today. And I know we've gone around. I mean, maybe people thought they bought it and it was moving back up, only to see things selling off again. We'll talk to some of our guests and ask those questions. What about a name like D.R. Horton? It had a double beat, but I saw a down arrow.
Yeah, this one has been gyrating all this morning here. It's actually up about 0.5% now. Early on in pre-market trading down about 6%, so it has been able to recover here. They actually did beat both on the top and bottom line. EPS came in at $2.03. Street was looking for around $1.93, and revenue came in at $6.89 billion, down from what we saw a year ago at $7.61 billion, but did exceed the Street's expectations. The reason why we saw this pullback to the downside initially initially, especially on an intraday basis, is the conference call. The company has seen an uptick when it comes to activity, but it is also eating into its margins by providing these incentives or these pay downs in order for individuals to buy into their homes. And if you are going to see a stalling out of that backlog, that could actually have an impact on the revenue growth moving forward. So once again, a little bit more uncertainty when it comes to the housing market here. I would say mixed results at best. Guidance may be a tad bit weak when it comes to DR Horton, but individuals are trying to buy this name up. Once again, up about 0.5%. That's a pretty decent recovery, Nicole, from the pre-market lows.
All right, great to see you. Kevin Green, thank you so much. Appreciate it. A good look at a couple of important names there. This is the Dow's about 847 points to the downside. So we are seeing some selling. We'll try and make some sense of the action here and what's to come in this first half of the year and the back half. Let's talk bigger picture. Adam Coons is with me right here on the desk, Co-Chief Investment Officer at Winthrop Capital Management. Thank you so much for being here. I mean, people come in and they say, oh, it's the worst day. And, even though we're not too far off from highs, it does breed that sort of freak out moment when the VIX goes to 20 and people say, what's going on?
Totally.
Right?
I mean, look, you got to put full context in the matter that we come off of 3 years of equity markets that were up, almost 20%, 3 years in a row. And so you're going to come off of that. You're going to have some volatility. And it doesn't help when you have, the Trump administration that kind of likes to be that gasoline to the fire sometimes. And so I think that's what should be expected this year, similar to what we saw kind of the first quarter of last year. If you think back, kind of the tariff tantrum and some of the things that were happening kind of in the first few months of the year as markets were digesting kind of what Trump and the overall kind of changes in the administration were going to do to markets. And we're kind of back there where markets are trying to filter through the noise to see, okay, what are the implications, impacts, what's real, what's not. And so, I think we'll probably see more of this kind of volatility in the beginning of the year, but that will give us opportunities, new things to buy, new ideas. And so, in some ways, it's a little bit exciting when we have markets like this.
So I know you have some different strategies and investment themes to go over. I saw them within your notes. More tailwinds or headwinds now going forward? I know you're looking at central banks, and where does that fall into your story?
Yeah, I think overall, kind of the monetary shift, monetary policy in 2026, the whole year will be a tailwind. I think we'll probably see some headwinds, like I said, at the beginning of the year, because first, Trump's got to figure out who he wants to appoint as the head of the Fed.
True.
So, we still haven't figured that out. So that'll probably cause some volatility as you see swings and who's going to be. It'll probably be a little bit dramatic.
We have Warsh at 60% likelihood, but that doesn't mean anything yet.
So,
okay.
So, how that kind of plays out will probably affect markets, increasing volatility. But overall, we think that the shift towards, in the kind of monetary policy, will be towards easing, further easing. For us, we're really focused on the reintroduction of quantitative easing, where the Fed goes back to buying securities in the open market. That's something they haven't done in a while. They've been letting different types of securities run off. They've been reinvesting Treasury maturities, but they have not been reinvesting mortgage-backed security maturities. So we think that there's a high probability that they move back towards buying mortgage-backed securities kind of as the Trump pushes to get mortgage rates lower. That would be one way to support that market, to support longer end interest rates, because the Fed can only really impact short-term interest rates. So the only way they can impact long-term interest rates is to actually buy those securities.
And the global equity story then, obviously you're leaning more towards tailwinds. You want to be invested. You talked about defense plays maybe. What kind of global equities or U.S. equities should we be in then?
Yeah, so I think another thing that we saw last year that we think will continue this year is that shift away from U.S. stocks and towards international stocks. So for the last decade, last year, U.S. stocks have outperformed international stocks dramatically. Last year was the first year that international developed stocks outperformed. At its peak, the difference in performance was 17%, meaning that international stocks were outperforming U.S. stocks by that much. It ended the year close to 10% was the gap, but still outperformed. And
And we think it's probably going to happen this year as well. And you're already seeing that this year. That's the big reason why we're seeing gold at all-time highs. It's really that shift away from U.S. assets into other types. And so gold is one of those, but then international stocks is another. And as you see kind of this shift in getting the EU to spend more on defense, that's where we see kind of the defense spending in particular kind of in Europe is a big play for playing defense companies.
I do want to sort of know what kind of international plays. I mean, because there's a lot there.
There is.
You could talk about large cap or value or emerging markets or, I want to get to small cap equities too, but just a thought on international. If someone wanted to take a bite into that because you do believe that that's a good place to invest, could you be more specific? What kind of international?
So, because to play into that, we do still like the tech play. Not pure AI per se, but overall we think tech is going to continue to lead markets. So looking at different ways to play that. So that would be Taiwan. So Taiwan Semiconductor is one of our top stocks.
Oh, that's one you like. Okay.
So that's one way to play international, but you're also in the same theme of technology growth, AI growth, that sort of thing. So overall, kind of from a country exposure, we like Japan, we like Taiwan, South Korea. So like I said, the really tech-dominant portions of kind of the equity space. And then additionally, we like financials, which is another reason why I like Japan, because that's really a blend of tech and financials. We do think we're going to see deregulation just globally for financials, banks in particular. So that would help with some M&A activity that we think could benefit a lot of Japanese banks. So really that kind of Southeast Asia is where we'd really like to be. We do like some spots in Europe, but like I said, overall.
And you liked energy. I saw, and you had Nextera Energy. Is that a name you like?
Yep. So overall, just kind of the energy space. It has had some bumps a little bit last year, but we think that we kind of stabilize energy prices. We do think some of the global conflicts generally will start to kind of go away, which should help energy prices, like I said, stay stable, which is really the most important thing. Not necessarily that we need to see energy prices go to the moon. We just need to see stabilization, which we think is really what we have on the horizon.
It's great to see you, Adam. Thank you for being here in person, giving us some plays for the new year for 2026. Appreciate it. Adam Coons, Co-Chief Investment Officer at Winthrop Capital Management. All right, coming up, Options Corner, real options trades. Rick Ducat is combing through, and he'll highlight some usual options activity from the day, how investors are looking to trade on recent news of Microsoft, Honeywell, Mobileye Global. We'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to the Watch List. I'm Nicole Petalides. It's time for Options Corner, where we analyze unusual options trades that we're seeing throughout the day. We welcome in Rick Ducat, lead market technician. He's going to take a look at three names that have been busy in the options market, and he's found three real trades. In the meantime, maybe just a quick market thought. We're seeing down volume surpassing up volume 3-1. We're, at session lows of the day, people running to the safe haven of gold, and a lot of these tech names continue to be in focus. And Netflix reports after the bell, Rick. I mean, what are you looking at when you look at some of the levels or actions? You see us down over almost 2% now on the S&P, right?
Yeah, definitely a painful way to start off the week here. Not really breaching major supportive levels just yet here, but it depends. It's kind of a stock-by-stock situation here as we digest some of this news here. Oftentimes, just a general thought when there is surprising pieces of news, such as the news surrounding Greenland perhaps today. Oftentimes there can be a sharp reversal which gradually changes course and things are back where we started within a few days here. Not saying that's going to happen, just saying, don't panic. Like these things happen.
Right, so stay nimble with the VIX at around 20. We'll have to wait and see. In the meantime, Microsoft, you're taking a look at Microsoft and you found a bullish trade, an options trade that you're going to share with us. Now, let's hear a little bit about that one.
Right. So it can't ever be good news if the world's richest person is trying to sue you, even if you're a company as big and as powerful as Microsoft here. But that's kind of the main story I saw today. Microsoft and its OpenAI kind of subsidy, I guess you might call it, are being sued by Elon Musk, who is seeking $134 billion in damages, alleging that the other companies wrongly gained from his financial and strategic support. Kind of the sticking point is that OpenAI shifted from being a nonprofit to a for-profit company. So that is why Elon Musk is making this lawsuit allegedly here. So we can also see a couple other headlines that caught my eye. Microsoft's OpenAI-backed subsidy, once again, reached $20 billion in revenue on Friday, according to its CFO. So making some major strides in that arena here. Also reports that Microsoft and NVIDIA plan to invest up to $15 billion in Anthropic, which is the Claude large language model maker there. So additionally, too, price target cut from TD Cowen, 625 from 655. They kept their buy rating, though. But this trade is a big one. Plus 15,000 March 20th, 435 strike calls, and a 3301 debit here. So a bullish opening trade here. As always, I try to find only opening trades for this segment here. A $49.5 million debit paid here. So that was a pretty darn big number here. You don't see that sum often. But we do see that this was a trade that for which, same thing as always, long calls, unlimited potential max profit. Debit paid would be the max loss here. Break even 461.01, 3.3% to the upside here. Expected move well within that boundary there. Expected move 9.6% during the next 59 days here. This trade at the time I checked too was sizable. It was about 7% of the total options volume in this name here. So a noteworthy trade from not only the dollar amount but also the volume.
Yeah, it was interesting because Microsoft was listed in Dan Ives' notes today. He has the Ives ETF, but he said between the war of words between President Trump and the EU that it really will give investors another opportunity to step in and own some of the tech winners. Despite the bears, he says, trying to yell fire in a crowded theater, the AI revolution is still in the early days of playing out. So he's on board with Microsoft, NVIDIA, Nebius, CrowdStrike, Apple, Palo Alto, Google, Tesla, etc., Palantir. Let's talk about Honeywell. Now, in this case, you found a neutral to bearish trade. Tell us about that one.
Right, so a name maybe you may not instantly recognize, but look around an apartment building or some kind of other large facility. You'll probably see these types of products from this company here: building automation, industrial automation, aerospace technologies, power controls, etc. But the chart has been pretty nice for this name here. A pretty strong rally since the last earnings, up about 10%. JP Morgan also upgraded this name on Friday to overweight from neutral. Price target up from 255 to from about 205 here. So there's also news reports that say Honeywell's quantum computing company called Quantinuum is preparing to go public. So that's a lot of the buzz that I've seen around this name recently as well here. So that would certainly be pretty interesting. I'd be curious to see.
Oh, who's that blue face head as well?
On my line.
Somebody is about to catch
I don't know who
a
that
loss.
is.
Come on now.
It's over.
Frost, goddamn.
Oh.
I had to give it to you because the point guard was in the crowd. Oh my god, he dunks on everybody.
Go up to the ball, Braden.
Please, let's go.
I was closer to him than he was.
Yeah.
It's fine. Fuck
Oh
it.
my god. It's alright, y'all. First jumper with out there. It's alright.
You're good.
I'm good though. I'm missing that ball. What's that? What's that? Frost, what's good?
Come on, Frost. See? That boy solid.
Come on, we good, Frost. Let's go.
He must be cold. He's having a campfire down there.
Good shit. What a block. That boy, Frost. Make up for that.
Come on. Here.
Shoot.
Wait. Fuck.
I got it as fast as I could to you, Lance.
I
You
know,
gave it
bro.
to
I
me.
know. It's good.
Yeah.
I ain't tripping. We got it.
We good, though.
Yeah, we good. Where my blunt at? Here we go.
Of the total options volume in this name at the time I checked here. So this trade was really a standout here in this symbol as well.
All right, and last but not least, you look at Mobileye, and while it had a nice, big candle popped up recently, the story is that it's gone from $20 down to $10. Right now, $10.67. But there is some bullishness in there. Let's hear a little bit about that.
Yes, a more long-term bullish outlook for this name that's involved with autonomous driving technology here. Earnings Thursday morning, but this trade doesn't seem to be really focusing too much on that. As I said, this is a longer-term trade here. The recent news has not been super positive. We saw a downgrade from Wolf Research on January 12th down to neutral, and price target cuts from UBS and RBC, both from 13 from 17, 14 from 18 respectively, both kept a neutral rating here. So this trade, though, is more bullish in a way that would have a much farther duration than the other two we're talking about. Plus 8,227 January 15th, 2027 calls at a 169 average debit here. So again, a bullish opening trade, max profit potentially unlimited, max loss $1.3 million debit paid here. What I saw in this name, though, too, as well, was a lot of other similar trades around that same time. I can't really be sure. It seems likely this position is actually perhaps even bigger than being portrayed here, but these are the ones that were kind of all at the same time. Again, a very sizable trade. This single trade was about 15% of the market at the time I checked here. Looking for a move still within the expected range, which gets kind of less and less reliable the further out you go. But break even 1669, 53.8% to the upside. So certainly looking for some movement. Expected move, though, 62.5% potentially during the 360 days, almost a full year out for this trade, or 2 years, a year out for this trade, excuse me.
Okay, well, thank you for all of that, Rick Ducat. Real trades in the options corner. We appreciate it. Looking there at Microsoft, Honeywell, and Mobileye. Nice to see you, Rick Ducat. Thank you. Coming up, tech stocks. AI revolution. Are people now, they want to see more. They really want to know, what is all this CapEx spending for? Our next guest says, show me the revenue. We'll be right back.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to the watch list. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange. Stocks are selling off. Global bonds are selling off. We're seeing yields rising, particularly in Japan. Keep an eye there. Here at home, we have 4.28 on our 10-year bond yield. A lot going on. Joining me now, Lisa Martin, MarTech analyst over at Lisa Martin Media. Thank you so much for being with us, because there's thoughts that a day like today or a time like now could be a buying opportunity, and others like Deutsche Bank are saying, cheap software stocks, are they an AI value trap? Because, we're seeing a lot of cyclical spending. So which is it? How are you feeling about tech weakness and the sell-offs? Are they opportunities or no?
There are opportunities, Nicole. Great to be with you. Happy New Year. It's great to be on the show. I think the tech slump that we saw last week, the week of January 12th, it looks more like a reset than a real warning. We've seen this huge AI-driven run recently. So some profit taking, some rotation, probably overdue, especially at the start of the year. From what I'm reading, it looks like a healthy market behavior. I think what's important here is that nothing fundamentally broke. Earnings expectations, they held up. Balance sheets are strong. Demand for AI, for cloud, for semis is still really, really real. But what changed is tone. Investors are shifting from excitement to execution. They want to see that, because companies that I talk to every week, they have to shift from experimentation to execution. So investors are asking, well, which companies can actually monetize AI right now? Can they justify this massive CapEx? Companies on the hook, they have to show, they have to demonstrate ROI from AI projects. And that's putting pressure on some names we'll talk about. But I also think it's improving the quality of leadership in the sector that we're seeing.
See, something like Taiwan Semi last week, when they talked about the CapEx spending of $52 to $56 billion, they need to speed up everything in order to meet demand for the AI processors. And, it was pretty amazing and really sort of meaningfully shifted confidence in tech, in the AI revolution. This was on January 15th. It's January 20th, and today we're back to, is AI sort of too toppy or frothy, or, what do we need to consider here now? What about a name like NVIDIA? What do you think about a name like NVIDIA? Where do we stand on that kind of name?
Well, so what's interesting right now with NVIDIA is the administration is saying, NVIDIA, you're going to need to meet tighter security and export requirements before shipping the H200 AI chip to China. But we also know that this chip it's pretty premium, it's pretty high margin, so any new restrictions might raise questions about it. But I don't think it changes the bigger picture, because China isn't NVIDIA's primary growth engine. The real demand that we're still seeing, it's coming from U.S. hyperscalers, it's coming from allied markets that are spending aggressively on AI infrastructure. So I think NVIDIA's AI demand story is still intact. I think it just reminds investors that geopolitics, it's just now part of the semiconductor landscape.
Intel there with some green, and that's because Intel got an upgrade to a buy over at Seaport today, a buy from neutral with a $65 price target. SanDisk has been a leader. It's up 8.5%, folks, with Citigroup putting a 490 price target and a buy. So there are some bright spots. Is this a stock picker's market? What kind of stocks do you like? For sure.
I think it is a stock picker's market. I think we've seen that kind of proving over and over again. But some of this, what I see right now is that we're in this accountability phase with AI, that companies, they have to show up clearly. And I think it's most clearly in software. So for the Salesforces, the Adobes, we know that conductors and infrastructure, they're still benefiting from a very visible AI spending ratio, but the software companies, they now have to prove what they're doing. I think where execution is clearest, where AI is concerned is, and tied to real spending, is semis and infrastructure. NVIDIA, Broadcom, AMD, they are clearly benefiting from visible demand, backlog. On the platform side, we see Microsoft standing out by monetizing AI through Azure, through Copilot, while Google is showing more discipline around AI cloud efficiency. And when I look at cybersecurity, two of my favorite companies, Palo Alto Networks, CrowdStrike, they're executing because AI is driving must-have spending. I think what we're seeing, Nicole, is this common thread that's really simple. Companies that can point to customers and pricing and use cases, they are being rewarded in this accountability phase versus vagueness.
So Palo Alto and CrowdStrike are a couple of your favorite companies. I saw Apple was added as a top pick somewhere today. I mean, there's always what happens to Tesla next kind of thing. Of the other big names that you want to see some revenue, for example, for Alphabet, Google, people actually like the cash flow and the fact that they can make deals or CapEx spending with actual real cash versus some of the cyclical promises and spending that we've been seeing. So the show me the revenue phase, which companies are you most worried about then?
I guess I would be concerned, the whole Jerry Maguire, show me the money, 2026, it's show me the revenue. If we look at Apple, which is reporting next week, it's not about flashy AI headlines. Investors are caring about things like services growth and margins, and they want to see a much clearer sense of how is AI actually becoming a monetization lever for Apple. I think with Tesla, there's pressure on margins. There's clear pressure on demand. I think long-term AI and autonomy stories matter. But right now, the stock needs this near-term execution. It needs cost discipline. I do think Meta is in a bit of a stronger spot because AI, it's already improving ad performance and efficiency. We're seeing that. So investors are focusing on whether results from Meta continue to justify the spend, the CapEx in AI.
Are you concerned about Adobe and the pressure there?
I think from an Adobe perspective, some of the things that we're seeing, there are concerns there. There's concerns with Salesforce as well, because what's important is that from an accountability perspective, as I mentioned, we need companies to reward, they need to be clear. They need to be not vague in terms of where AI is actually a product. We're seeing scrutiny around names like Adobe, as you mentioned, Nicole, Salesforce, some other mid-cap SaaS companies, where investors are saying, is AI actually incremental here, or is it bundled without pricing power? Where we're seeing wins are with NVIDIA and Broadcom and AMD, because execution is clearest, where AI, it's tied to real spending, it's tied to visible demand. We're seeing on the platform side, Microsoft stands out. It's monetizing AI through Azure, through Copilot, Google showing more discipline in AI cloud efficiency, and then, of course, the wins I mentioned with Palo Alto Networks and CrowdStrike on the execution front, because AI is showing spending.
I had a guest today who talked about it being a midterm election year, and when you go back to the 50s, I mean, usually this kind of year doesn't do particularly well. Has an up arrow, let's say, to the tune of about 4.5%, but we're not going to see 20% type of thing. And really a broadening out of market breadth, that it's not the Mag 7, it's sort of all the other names. Do you see us higher in December, let's say, or end of the year, are we higher than where we are now for the major averages?
No threes.
God damn it, bro.
No threes at
Frost,
all.
you needed one more, bro.
Nothing.
In that
We
corner.
needed nothing.
Nothing at all. Yep,
Yes,
that's
it
us.
is.
Let's go.
That's us. Hold it. Whoever got free throws,
Yep.
somebody get it.
Pass it back to me, or small forward can get it. It don't matter.
Keep it away from them. I meant to tell you to press RB8 last, because then you would have had the point guard. You would have ran the timeout.
No, I don't think I.
Let's
I ain't
go.
passed that in.
No, I passed it to you just to get the crowd to go to you because they wasn't near you. But if you would have pressed RB8 as soon as you got it, you would have dished it to him.
Watch the lob.
Shit, I ain't even gonna tell you what I tried to do. I tried to hit Frost's ass. I seen Frost cut it. Yeah, he was gonna score. Oh no.
No, he good,
man. Get it. Dang.
It's a close game.
It was.
Good game, man.
God damn.
Crazy.
I'm going back game chat, y'all. I mean, party chat, y'all. You heard?
Me too.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on X at Sam_Vardis and connect with me on LinkedIn or Instagram for more.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to the watch list. I'm Nicole Petalides. It's Technical Tuesday, and want to drive through some of these charts. Rachel Deschelle joins us, Senior Manager, Trading and Derivatives Coaching. Charles Schwab, I'm so glad to see you, Rachel. I haven't seen you yet in the new year. Happy New Year to you. I was just thinking how, we have these S&P 7000 hats, but they have to stay in the box until we cross 7,000 and close above 7,000. We were about 15 points away from S&P 7000, and now here we are down 2% at 6,800. What levels are you watching today, and why are those levels important?
Yeah, great to see you as well here. And like you mentioned, those hats got to stay in the box for now, because we did see at the end of last year and the beginning of this year that performance was strong. It kind of formed this almost rising wedge type pattern. We also saw, as the same time that this kind of formulated in price, we saw that waning momentum there as well, which was kind of one of those first warning signs that, hey, this speed of the trend may be slowing down a little bit. And obviously we're getting that signal of that reversal today with that breakdown through a couple levels of support, one being trend line support there in that rising wedge formation, as well as that 50-day simple moving average as that old level of support, which now becomes new resistance here. And it's kind of, with price not being able to hold that 50-day, it's kind of giving that signal that buyers aren't really stepping in quite yet to buy this dip. So given that, traders may be expecting another flush down to the 100-day moving average right around 67.45 or so, which is less than 1% away from where we're trading at now. So it wouldn't be too surprising if we did find that level as that next level of support. Now that level also coincides with December lows as well, so there's obviously a confluence of support there. But as far as just kind of overall participation, overall market breadth, we have seen some defensive rotation lately. Tech just continues to drag down the index on the surface, but under the surface, strong breadth remains overall. We do see that advanced decline line at the bottom of the screen there, coming off those all-time highs of last week, which is still remaining strong from a breadth perspective.
All right, well, thank you for that. Really appreciate it. Right now, market breadth, we really see more of a sell-off with 3 to 1 down volume to up volume at this moment. Then we have a name like Hecla Mining. Why did this name jump out at you, this chart in particular?
Yeah, so this chart in particular, just due to the outperformance that we have seen in some of the metals and some of the mining stocks, this one has been on the watch list. Today it actually reached an all-time high, and I thought it was even notable as well that the last all-time high for this name was actually in 1987. It just surpassed that level today. So from base pattern lows to these yearly highs, Hecla's gained over 530% this year. It's been on specifically just a tear on the last 6 months. Momentum's remained strong through this entire trend. You see a lot of red at the bottom of the screen there. It's spent a lot of time in those overbought levels, which just is such a signal of how strong of an uptrend it has been, and it's remained in that bullish regime above 50 as well. And even today with the breakout to new all-time highs, the RSI is reaching above 80, so extreme momentum there. And you know what they say, I mean, the trend is your friend. Many buyers may be kind of cautious at these extreme trend and momentum levels, that they may wait for a pullback to participate if they haven't been able to already. And this name has given multiple areas to enter the trend on a pullback, which I've kind of highlighted a few there in gray, and you can see some retests of that 20-day moving average. The most recent level to watch would probably be right around 23 or so. We saw consolidation there for a few days before moving higher, and if price pulls back, it may find that familiar level of support again.
Yeah, no doubt. And just overall, like precious metals, I see this name here doing so well and moving to these new highs, but precious metals overall, people are running and investors are seeking some safe havens like gold, like silver, as President Trump and the war of words with the EU and Greenland and tariffs, NATO have really brought some uncertainty to the market this week now, right? This first day of trading. Last but not least, Accenture. Tell us about this one.
Yes, so this is the last one here, and with this one, I would definitely agree with your last guest, Lisa, when she talked about just the software industry being under pressure lately and the opportunities that still exist in the software industry. So I would say ACN is definitely a software stock that has been on the watch list. It looks to be improving, technically speaking, trend-wise, and especially if you look at relative strength versus the overall tech sector and the S&P 500, which that ratio comparison to the index is down below on the chart. But the thing that grabs my attention here on this one is that really large 6-month long cup and handle pattern with a breakout from that formation last week. Now this breakout really forms this new level of horizontal support right around 280, which is kind of being tested right around today. And just like this last one, it has been a confluence of support there. So that horizontal retest, it just kind of walks hand in hand with that 20-day moving average, which just reiterates how crucial this level is to hold for this stock, really in the long and short term here. So traders looking to enter on a retest of this support may be looking for confirmation at this level in a number of ways. So looking for possibly a follow through tomorrow, that close above the high of the low day, maybe a percentage move. But as far as just shifting to that initial breakout in trend that we saw there and the breakout that we've seen in relative strength versus the index, when we see those two factors happen simultaneously, that typically gives a really powerful sign as far as just attracting more capital to the name in hopes of alpha here.
All right. Rachel, Michelle, great to see you. Thank you so much. A good look there at some key levels to watch. Senior Manager, Trading Derivatives Coaching, Charles Schwab. Thank you, Rachel. And coming up next, folks, markets selling off. We'll continue to follow today's sell-off here on Wall Street, but also all things Netflix. The Netflix earnings are due out after the bell. We still, of course, have the Warner Brothers deal that they're working on. What do you need to look for most closely here in these earnings that are due out? We'll be right back.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions. From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Hey, investors, you know the market moves. Schwab is here to help you move with it. So, whether you're buying, selling, holding, planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Sam Vardas, live from the New York Stock Exchange. When the market moves, we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Welcome back to the watch list. Want to talk all about Netflix. We have earnings after the bell. Of course, we have the big deal with Warner Brothers, so we want to talk about that as well. Alicia Reese, Senior VP Equity Research at Wedbush, and Seema Shah, VP of Insights at Sensor Tower, are both with me now. Let's talk. I want to talk about the earnings and the numbers, but I do want folks to understand that really Warner Brothers is really picking Netflix at this time. They've moved to an all-cash offer. The boards of the two companies have approved these offers. The Hollywood heavyweight fight between Paramount and Netflix for Warner Brothers right now, it's really looking like Netflix, where they're sticking to their $27.75 a share. So this afternoon, we're going to be talking about monthly active users of Netflix. Seema, you have a lot of stats on how much people are using this. Tell me a little bit about some of the streaming numbers.
So just to put into perspective, globally, Netflix is the largest streamer with about 48% share of MAUs. HBO, if we're going to just, kind of keep it parallel with the deal, is, about 10% share. So together, they would obviously be over 50%. And then to put that in perspective with Paramount, it's in the low single digits. So significantly smaller. And what we're seeing is obviously Netflix is so large. So adding subscriber growth is not at the same rate as HBO is, which is the fastest growing streamer that we're seeing right now. But Netflix has the most loyal customer and the most engagement of all of the streamers.
Netflix is still the heavyweight player at 48% of the monthly active users for streaming. Alicia, what are your thoughts? I mean, there's probably some good news and when we talk about tailwinds, but also some headwinds. What do you think is working for Netflix? And then what are you worried about?
Yeah, I think there are quite a few things that are working for Netflix right now. The survey work that we did in the quarter indicated really low churn and some interesting moves for people who hadn't been on the service for a while, at least 3 months, are poised to come back in the first quarter. So, I think Netflix has a really big opportunity to leverage its advertising. It's made significant improvements over the past several months, increasingly giving advertisers a lot more data and attribution. Advertisers have a lot more to do on the platform, and Netflix has a lot more space to increase the ad load. All of those things point to higher ARM for Netflix, and when you have some really good subscriber retention and really low churn on price increases, that spells profitability.
We talk about, thank you for that, also about how many minutes, not only the monthly active users, but also how engaged are they? How many minutes are they on there? When you have big shows, I'll throw in Stranger Things or something like that where people are binge watching, but you're not really getting as much churn. People may go in and out of some of the other streamers, but they stick with Netflix. Talk about some of the other stats. You do actually have the proportion of total Netflix users watching Stranger Things, which is funny.
Yes, and similarly, if we want to talk about another show, there's about 30-40% for Stranger Things and Netflix, and on HBO, Heated Rivalry is over 30% at peak viewership, which is another show similar stats to White Lotus that HBO had. So this is kind of interesting to put in perspective what could happen if the two companies are together and they could bring that loyalty on HBO shows. But yes, in terms of Netflix, it has a very loyal customer. About 91 minutes per week are spent, about 11 sessions over the average for the group. So people are very engaged with it, and the way that they lay out their shows by having portions of the season spread over time helps to maintain that low churn rate. So people stay on the service to wait to see the next part of the show.
With some of the research I was doing today, we were talking about earnings growth near 30%. Expectations for fourth quarter profit, $2.4 billion. Advertising could in fact be the real bright spot and could be number one in revenue engine for 2026 for Netflix. Alicia, what say you about that?
Yeah, I think that they have an opportunity after not giving subscriber or ARM numbers for the past, 3 quarters to, at year end, give a little bit more data there. And I think because the stock is so oversold on this M&A overhang, it's an opportunity to get the stock working again at the end of the year and into 2026 as they move forward. This, whether or not they get this deal done, and it looks like they will, it's going to be a long time, and this overhang is going to last. So I do think they have to give investors a bone.
Understood. And what do you want to add to that, Seema?
From our data on advertising, right now Netflix has about 8% of the U.S. ad market. But it's growing and it's growing rapidly, and the fact that it has such a loyal user is what makes it such an attractive platform. So we're seeing it continue to gain share. Hulu remains the largest OTT advertiser that we follow, and if there was a merger with HBO together, they would be the second largest OTT advertising platform.
HBO Max, I guess, has a big footprint abroad, from what I understand.
It's growing, yes,
it's
quickly.
growing abroad,
yes.
Which actually that's a good bright spot for that company.
Right.
But this conference call today may be a lot about Warner Brothers. I mean, let's just call it what it is. I mean, people are not going to be, maybe as enthralled in how many minutes on this or whatever. They're going to want to know about Warner Brothers. Alicia, what do you think they're going to say about Warner Brothers today?
I think they're going to reissue the statements assuaging the Hollywood community who's concerned about shortened theatrical releases or straight to streaming. They've made some statements, giving comfort in that, is saying that, look, we're committed to the theatrical exclusive releases, with the Warner Brothers content once we have it. And I think as long as they continue that rhetoric, that will be really helpful. They also have a lot to say about what they plan to do in terms of using their very huge finances to put out more titles, more on TV, more in the theaters, more overall, and not, if it stays in Warner Brothers' hands, it's a big pullback in content spend Paramount will have to do some cuts as well. Netflix will spend more on content, and I think that gives everyone a lot more confidence.
Yeah, Alicia, thank you. 15 seconds. How many streaming services do people have? Do they have Disney? Do they have Apple? Do they?
Most of people do have at least probably 3 or 4, and they rotate them based
Are they
on
going
the
up or
tentpole.
down in the new year?
The way I look at it, I think that there's more pressure. It's going down. We've seen competition take over. Monthly active users are growing on a global basis, but there's a lot of competition for time from the social media companies, from short form video. So there's a lot of competition going on for those minutes.
Seema Shah and Alicia Reese. Thank you both. Alicia, Seema, great conversation. Everybody can keep it here on Schwab Network. We'll have all the details and the breaking news on Netflix for you. I'm Nicole Petalides. Thanks so much for being with me every day at 9 a.m. and 2 p.m. Market on Close is next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Spot insights, actionable data, financial journalists streaming live.
Any screen, anywhere, free. SchwabNetwork.com.
and the bottom line's guidance disappointed, sending shares down
You
as
gotta
much
be
as
the cold
8%, putting it on track for its biggest percentage loss since 2019. We'll break down those earnings and more in just a few minutes, but let's see how the markets are shaping up as we head into the end of the trading day here. We are maintaining this day of red that we've had throughout the day. More significant than this morning, though. At the S&P, we're down more than 2%, 67.97.94. On the NASDAQ, also down about 2%, 25,013 right now. On the Dow, we've given up 922 points, 48,436 right there, and the Russell 2000 down about 1 1/3% to 2643. On the 10-year, I just mentioned we're seeing levels we haven't seen. They're up at 430 right now, up 1.5%. The dollar is down 98.43. Gold trading at levels we've never touched before, over the 4,700 mark, 47.6450 an ounce. Crude oil dipped just below that $60 a barrel mark. We were above 60 earlier today.
Hey, call me back though. I'm gonna call you back.
Right now, up 1%.
When she's ready.
Bitcoin has fallen below the 90,000 threshold, down 6 1/3% right now at 89,580. I do want to bring in Alex Coffey, co-host of Next Gen Investing, to break down some of those top stories that I previewed at the top of this show. We've seen quite a lot of movement, some big moves despite it being a down day. Intel, one of them, moving to the upside today after some upgrades.
Yeah, picking up where it left off. It's already one of the top.
Bro, I just walked in here and my finger is static shocked. Bro, tell me, I keep shocking stuff, first of all. And number two,
Seaport Global Securities, the other from
no, it's not snowing where I'm at.
Getting to those just second.
No, it's not snowing. I actually was telling the story when you interrupted me.
As well as UBS.
But what happened was I static shocked my damn screen off. If anybody's watching the stream, my game went away. Just I don't even know what happened. How can a static shock do that?
Agentic AI is driving upside to its server central processing processing unit.
What does that even mean?
Demand, while also despite the fact that some
everything was just sitting right here.
Remain those uncertainties in their foundry business remain. They think that the engagement for the company is increasing. They do cite improving general server CPU from rising agentic AI.
Why is my stream
upgrade?
I gotta fix this.
Thought this was a little bit more of a interesting note. Got a little bit more in the weeds than HSBCs. This is Jay Goldberg upgrading to buy from neutral. Price target.
And what are you gonna do about it?
Share. So we're kind of getting back to the levels that we saw just a few years ago in Intel. If that were to happen.